Show, The Morning Brief. I'm Shauna Smith alongside Brad Smith. Let's get you the three things that you need to know today.
Good morning, everyone. First up, U.S. stocks getting a bounce from reports that the Trump administration is weighing gradual approaches to tariffs aimed at boosting negotiating leverage while helping avoid a spike in inflation. The dollar fell and the sell-off in treasuries eased after the report from Bloomberg. Meanwhile, December PPI data, that producer price index reading, easing some investor concerns on inflation ahead of the all-important CPI data tomorrow.
Plus, Google is facing a UK investigation over concerns that it's distorting the market in search and online advertising services. It's the first investigation under the tougher antitrust rules for the digital market. Now, the rules give the CMA more powers to impose fines and also gather data. Meanwhile, the EU is reassessing its investigations of tech giants, including Apple, Meta, and Google. This is according to a report out from the Financial Times. The review could lead to the European Commission scaling back or changing the sphere of the probes launched under the Digital Markets Act.
And China is weighing the sale of TikTok's U.S. assets to Tesla CEO Elon Musk, according to reports from Bloomberg. And those reports saying that Beijing officials strongly prefer that TikTok remains under the ownership of parent ByteDance. But guess what? Chinese officials have already begun to debate contingency plans for TikTok as part of an expansive discussion on how to work with Donald Trump's administration, one of which involves Musk. The video sharing app responded to the reports, calling them pure fiction. Global markets reacting here to reports that the Trump administration is weighing a gradual approach to tariffs. The dollar falling, treasuries pausing their sell-off, and stocks getting a bounce off of the news. There you're taking a look at some of the currency reaction plus bonds and the S&P 500 futures just to round out this board here. On the day, futures still pointing higher for the S&P 500. But more broadly here, there was so much of the larger consideration, even coming into the election, around what some of the tariff activity, what the implications could be. And it's not just the imposing of U.S. tariffs, but the retaliation that the markets were really trying to get ahead of and best anticipate as we move from campaign talk into now real policy that could come forward. Yeah,
it's just another day. I mean, President-elect Trump still isn't even in office, and we have another report that's obviously market moving, and it's out because of the tariff talk, and his team is trying to mitigate some of the risks that have been associated with tariffs. When you talk about the potential implementation and the plans and what we've heard some of the rhetoric here from President-elect Trump, the big question mark or the big concern here from investors is the scale of these tariffs and the ability here to, or potential here, that they could possibly reaccelerate some of the progress that we have seen made on inflation. And of course, that is a huge issue here to the market. So this time around, this report here, talk here, the slowly ramping up tariffs on a month-by-month basis. It would be a gradual approach. It would be used as a negotiating leverage here potentially. But you also had some quick reaction out this morning. One was from UBS saying that this could actually still be inflationary here to the market. So maybe it's alleviating the worst-case scenario type of talk that we've heard surface over the last couple of weeks. But still, when you talk about tariffs, the impact that it could have on the economy in the longer term is still clearly a big question mark here for investors.
Yeah, I'm taking a look at some of the data and ultimately what was published by China Beige Book. They are, like many out there in the markets, trying to get ahead of what these tariffs could potentially hold and the sector impact as well. They did mention within their most recent note that had come out just a few days ago, manufacturing has benefited from months of pull forward expectations in anticipation of 2025 Trump tariffs, but that spigot ran dry. The sector weakened in Q4 across nearly every major indicator on quarter and on year here. And so even as you think about where there already has been some of that pull forward in purchase orders in order to try and counter or for businesses to try and make sure that they're not seeing an added expense, that's going to be a larger question mark as to where we see this hit expense lines in even a phased in approach for tariffs.
And according to this report out here from Bloomberg, the proposal is still very much in the early stages, has not yet been presented to Trump. And I bring that up because we've seen him take to Truth Social and kind of refute some of the reports that have been out most recently regarding his tariff plan. So again, we could see another market moving update here as throughout the day. All right, the question is, why are those in the Trump world floating so many different tariff ideas, and what are the implications for the market and for President-elect Trump? Joining us now to break it all down is our Washington correspondent, Ben Worschel. And Ben, it's great to have you here. I guess, what is your assessment of these developments that we're getting on global tariffs and the possibility that we could see gradual implementation of them?
For sure, yeah. As you mentioned at the top, this is kind of the latest report here, and it's been kind of a choose your own adventure over the last 8 days. We've seen 3 different ideas that are floated. They're not in direct conflict with each other, but it's sort of evidence of a really rollicking debate going on inside Trump world right now. And to me, it's also evidence that there's no plan that can kind of span 2 competing impulses within Trump world. One side is Trump himself, who all evidence shows wants to go big on tariffs, wants to go heavy on tariffs and dramatic, even on day one. And he's given signs he's planning to do that. And then also these market reactions you're seeing. Today's report obviously is getting a more positive market reaction, but we had one last week of just a simple economic emergency, which had the opposite reaction. Another reaction this morning is from Signum. Andrew Bishop there at Signum had a good point, which is that this latest plan, this gradual tariffs, is kind of in the middle and perhaps unsatisfactory to both sides. It doesn't sort of accomplish the big dramatic move that Trump is clearly going to want, and as you noticed, it apparently hasn't been presented to Trump himself yet. So we'll see what he actually thinks of this idea. But on the other side, it does still have big tariffs coming in, just more slowly. So if you're a market, you're forward looking. Does this actually mitigate any of your concerns? That's all being sort of hashed out right now. And then with the X factor being Trump himself, who repeatedly talks again and again about how he wants tariffs for tariff's sake. He had a press conference last week where he talked about he didn't want tariffs as a negotiating point. He wanted them to bring manufacturing to the U.S. That's his position. And the one thing he's pushed back on in these reports is a report about paring back. He said, "I'm not paring back my tariffs. It's going to be big. That's wrong." So what he actually does, we'll see. All these competing pressures on him, but it's a lot of push and pull on either side for sure.
Yeah, Ben, it's so interesting. And even as you were mentioning, and the reminder that just a couple weeks ago, we were talking about the risk or reality that Trump might declare a national economic emergency in order to move forward with these tariffs. And we put the question to Stephanie Roth of Wolf Research, who essentially we asked, is there anything in the data right now that actually suggests that we're in an economic emergency outside of us going crazy over the price of eggs from time to time? Right. And she said, no, there's nothing in the data. This is more strategic right now. And so what do you best extrapolate from what we're hearing about the incoming administration about what the real strategy is and where, in which regions of the world it's set to rattle or ruffle the most feathers?
Yeah. So first off, on the kind of the economic emergency question, my sense from talking to experts as well is that an economic emergency is kind of in the eye of the beholder, and being the president specifically. So the way the law is written is that the president can declare an emergency and just say it's an emergency, and that is kind of the end of that question. And then there's possible legal challenges, but if the president says it's an emergency, it's kind of declared of that. In terms of where it's going to impact, we're also getting a lot of mixed signals of there. Going into the election, Canada tariffs was not a big topic of conversation, but it's something Trump returns to repeatedly again and again about going after tariffs. He recently talked about tariffing Greenland. The big one, obviously, I think that'll be throughout his term is China. He's promised 60% tariffs on China. He's threatened new tariffs since his election, and so that's going to be the big one that I think he'll return to again and again, even after day one.
Ben, just really quickly while we have you, the Department of Government Efficiency, it seems like they're also kind of backing off exactly how strict or how they can actually get towards some of the targets they've actually put forward here. And we've heard this from Elon Musk even saying this is going to be harder to do than they initially planned. What's kind of knocking around within the inner workings of the incoming administration on that front?
Yeah. So this is a subject I wrote about this morning in terms of kind of you see this with a lot of incoming presidents where the campaign trail rhetoric doesn't quite match up with what the reality they face. Trade is an example of this, and then DOGE, as you mentioned. During the campaign, Elon Musk promised at least $2 trillion in cuts. That raised a lot of eyebrows because the entire U.S. discretionary budget is $1.7 trillion. So we would have to be cutting into things like Medicaid and Social Security. But Musk is already backtracking on that and talking about how 2 trillion is the upper limit and 1 trillion may be more likely. This is a pattern we're seeing across a range of issues. The deficit, Ukraine is one. Trump promised to have a single phone call and end the Ukraine war. That war doesn't look to be ending anytime soon. And a range of issues like this, where the kind of actual reality is hitting Trump as it has most presidents when they come in.
Ben, thanks so much for taking the time here with us. Top of the show.
Good luck to you guys.
Appreciate it. The other market movers that investors are watching today, of course, the economic data. PPI report ahead of tomorrow's all-important consumer price index report. Joining us now with more, we've got Yahoo Finance's own Josh Schaefer. This is one of the big reports that you said you were going to be looking for. Of course, CPI, you said yesterday, really takes the cake for you.
Yeah, Brad. So PPI and CPI together create pretty accurate forecasts for PCE. We're now getting into a lot of letters here, but PCE is sort of the Fed's preferred inflation gauge, right? That usually comes at the end of the month. So people take these two reports, get a pretty accurate forecast for what we're expecting for inflation for the month of December that we'll get the full report on later this month. Overall, this report seems like it came in better than expected. It came in better than the market was expecting. One key thing economists have been flagging in here was a large increase in airfares. That will feed into PCE. So to give you an example, Morgan Stanley's economics team was looking at maybe a 0.21% month over month increase for PCE. They just upgraded their forecast to 0.23%. So not a big move there by any means. And it seems like right now all the market really cares about is these headline numbers and the headline core number coming in better than expected. You saw bond yields tick down a little bit at 8:30. Obviously, that's a key story we've been watching, and futures ticked up higher at 8:30. So it seems like overall a little bit of positive news on the inflation front. Again, really, guys, ahead of that key report tomorrow. I think people don't want to read too much into this report ahead of the CPI release tomorrow morning.
Yeah, exactly. And Josh, that was the point I was going to bring up here, just in terms of the lasting effect of this. Very much we're already looking ahead to tomorrow's print and what exactly that's going to tell us. I'm curious just what you're hearing from your sources and the countless strategists that you do talk to about their assessment right now, just in terms of how much progress they expect to be made, not only here in these prints that we're getting out this week, but also what they expect in the coming months.
What's interesting is how split it feels like economists are moving forward over the next couple months. You can talk to one economist that will tell you they expect progress on inflation over the next couple months that maybe gets you a March cut, maybe gets you a May cut, or you could talk to some folks that feel like we're going to be in this sticky to flat period for several months now. Then you add in the tariffs, right? So that's kind of the key question here is, do we get these widespread tariffs? Are they actually inflationary? Is that a 2025 effect? And at what point are these prints at that point? Seems to be kind of where the street is a little bit split right now. But I do think the one clear read that we got, especially after Friday's hawk jobs report, is these inflation prints are what is going to drive the Fed narrative for now. That's why tomorrow seems so much bigger than it has maybe for the last couple months. There was a time period here where we were worried about labor market slowing. Labor market slowing felt like part of a reason the Fed might cut. Most economists over the last several days have argued that is just not part of the story right now. It is all about, is inflation going to come down? Remember that core CPI reading, it's been sitting at 3.3% for 4 straight months. So at some point you want to see some progress there. It's not about the fact that it's lower than we were 2 years ago. Are we starting to see any signs of progress of it coming down is going to be the key question and probably the market driver in the near term here, especially when we think about, again, that rising rate story, what can help us bring rates down, perhaps lower inflation readings, and then you get a little bit more of a risk-on vibe in the markets. I think we'll get a better sense of if we're ready for that after tomorrow's CPI release than we're getting today.
All right, maybe you'll be back on set with us to break it all down. All
Earlier,
right, Josh.
I hope.
One can dream. All right, Josh, thanks. We're following the latest developments out from JPMorgan. JPMorgan this morning announcing new responsibilities for senior leaders as President and COO Daniel Pintos announces plans to retire at the end of the year. Now, Jennifer Pipsack will take over as COO. This is effective immediately. She currently serves as co-chief executive officer of the Commercial and Investment Bank. Doug Petno, the current co-head of global banking, he is going to be succeeding Pipsack. Now, Marianne Lake will stay on as CEO of Consumer and Community Banking. Lots of questions, just ultimately what this means when we talk about the succession for Jamie Dimon. There's lots of talk. Jennifer Pipsack's name has been floated time and time time again as a potential successor here for Jamie Dimon. When you take a look at this move, you could maybe jump to the conclusion that she could be in the front runner spot. I do want to bring up a statement from JPMorgan provided to our banking reporter David Hollerith here this morning, and JPMorgan essentially telling Yahoo Finance that Pipsak's preference is for a senior operating role, that she's not interested in becoming or being considered for the CEO position. But you got to take a look at those three words, the last three words of the statement, at this time. So this could very much change between now and then. But again, the conversation here this morning, as you take a look at this, is ultimately what this means here for that top job once Jamie Dimon does step down.
Yeah, in previous testimonies in front of Congress as well, we've heard a lot of talk among bank executives, and most notably as well, Jamie Dimon, with regard to what that pipeline for the next leader looks like here. And it's long been questioned, okay, once we do continue to see JPMorgan moving forward, even in the formulation of the post-Jamie Dimon days, dare I say it, my goodness, he's been there and been a fixture in the industry, navigating the bank through many of the different crises that have rocked the economy. But all of these things considered, they've been questioned previously about what that pipeline looks like and if we could potentially see either a woman or a person of color leading the bank for the first time here. And many can argue that now with the COO position here, you have a pipeline for a potential where we could see the first woman leading the bank, leading JPMorgan Chase here, and the transitions that we've seen at some of the other past companies where COO kind of sits in that sweet spot where you have to understand the operations of the company, plus be able to really navigate everything from financing to marketing and people management as well. Of course, there are several different roles that have a C-suite title, but the chief operations officer typically is a person that's looked to for a lot of the intertwinings of those conversations. Tim Cook was COO before he became the CEO of Apple. And so all of these things considered, this is a prime scenario where we could potentially see the first woman be CEO of JPMorgan in the succession planning as well.
Yeah, and Dimon was just asked during an interview over the weekend about those succession plans, and he simply said that he doesn't know who is going to be succeeding him at this time. Well, coming up on Morning Brief, we're going to count you down to the opening bell on Wall Street as stocks trade in the green. Plus, we dig into the outlook for Nvidia amid curbs on its exports to China. And Google facing a UK probe under new laws. We're going to break it all down. What's at stake for the search giant? That's coming up next on Morning Brief.
Google's facing a probe in the UK over its search dominance. This marks the first investigation under tougher antitrust rules in the UK. Joining us now, we've got Patrick Moorhead, More Insights Strategy and CEO and Chief Analyst. Patrick, good to have you here with us. From your own read-in on this, what do these new rules mean for Google?
Yeah, right now the new rules mean nothing. The UK is trying to put its stamp as separating itself from the EU, and it has stepped up with even higher regulatory hurdles than even the EU. Essentially, it comes down to the dominance over the search advertising platform, combined with all of its different entities that it can distribute ads on. Now, what we've seen over the past 50 years, actually 30 years, is these things take a long time to work themselves out. And even if there's a negative ruling on Google, they can fight it for 5, 10 years. That's why the street typically has an initial reaction and then they forget about it until a later day.
Patrick, are there implications, though, for big tech more broadly speaking, just in terms of maybe some of the pressures, the regulatory pressures that we could see some of these other tech giants face from overseas regulators?
The short answer is yes. It goes back the initial statement is these things take time. Amazon, Apple, Google, Meta, everybody is being investigated or has been investigated. I look back at probably the last 20 years of antitrust enforcement and nothing changed. I do think the situation, though, is different. I think Google will be under intense scrutiny to split off the ad platform and the ad delivering properties, though, and that could be a monumental shakeup if it actually happens.
Let's turn to chip stocks here as well. Nvidia CEO Jensen Huang is visiting China this week as the White House announces new export limits on AI chips. The new curbs causing shares to sell off over the last several days here. How do you view these new rules impacting Nvidia and other chip companies in the year ahead?
First of all, it's pretty unclear and it's unprecedented. And what I mean by unclear is the ruling relates to semiconductors that either are purpose-built for AI or are designed for AI. And that would put all gaming chips, for example, in that category. They might be primarily designed for gaming, but they're very much designed to have AI capabilities in them. And on the unprecedented part, you're looking at 120 countries, many of them sitting in the EU, like Portugal or even Mexico, that now have limits on that. And this is all going to be managed by a government agency. And I can't think of a worse thing for innovation and speed and revenue than having a traffic cop. I think we're all in on national security, but this is the wrong answer, and I fully expect the new administration coming in to overturn most of the onerous elements of this and maybe provide some clarification.
So then, Patrick, I guess then that would lead me to believe that the market's reaction might be a bit of an overreaction if you are confident that we are going to see a quick change once Trump does enter the White House.
I mean, 2 or 3% and on Nvidia, and Nvidia was sliding based on the perceptions coming out of CES 2025. I think investors took it as a non-issue or a wait and see until the new administration comes in.
Okay, so all these things considered, how are these companies going to be navigating some of the international relationships that they've also communicated to investors is baked into some of their own growth anticipations as well?
Well, if this moves forward and it goes into effect in 120 days, unless the new administration comes in and squashes it or slow it down, is they have to hire a bunch of consultants to figure out how to manage that. There's a 128-page document that lacks a bit of clarity And what they're going to have to do is every company is going to come up with their own strategy to deal with this. A lot of companies aren't going to have an issue because they have nothing to do with clusters. But when you look at AI clusters, but when you look at companies like Nvidia and AMD, they're going to have to get, and even Intel, they're going to have to get very clinical on exactly how many chips that they can ship into a certain country. And I think the EU's response, that's typically pretty onerous and heavy-handed, they're even saying that this move is a step in the wrong direction and can potentially shift them in the hands of buying more from companies like Huawei, which is exactly the opposite of what this IFR is supposed to achieve.
Right. Patrick, we only got about 30 seconds left here. You got a lot of investors out there that have a buy on the dip mentality here. If you were looking for a dip in Nvidia, they essentially got one coming into yesterday's close. Shares were down by about 13% here. Is it safe to buy in on a dip like this, given some of the uncertainty and a new incoming administration, that Nvidia is still going to have to try and kind of win the positive fervor and attention of?
The short answer is yes. I think once we get clarity on some of the Blackwell rumors, I think that buying in the dip is a great strategy.
All right, Patrick Moorhead, thanks so much.
Thank you.
Got to move on to the latest on TikTok. TikTok saying that a report that it's considering selling its U.S. operations to Elon Musk is, quote, pure fiction. This coming after a report from Bloomberg that the parent company ByteDance is weighing possible sale of its U.S. business to the billionaire owner of X. Now, the Supreme Court is expected to weigh in on the future of TikTok. Currently, the law states that TikTok must sell its U.S. operations by January 19th. That is this Sunday, or face a ban. When it comes to what ultimately this means here for TikTok in the future here in the U.S., the Supreme Court last week seemed to be inclined to let the law stand, and that, of course, goes into effect this Sunday. Trump has said that he wants to find a way to let TikTok remain here in the U.S., so certainly setting up what has been and continues to be a battle inside the Beltway for what exactly should be done and needs to be done to address some of these national security concerns. But again, when you have Elon Musk, you had TikTok pushing against this report, but Elon Musk, obviously an insider within the administration, potentially as could be taking a stake in this company. It's raising some eyebrows.
You know, normally I would have said if only he didn't spend $44 billion on another social media network, only to figure out that it's going to be harder to turn that around than anticipated. But hey, he made that back essentially after the election here. Net worth sitting at $432 billion. You would imagine if he was to cash in on some of the shares or the options that he has for Tesla, that he could put together a decent stake and still be among the top 5 in the most valuable people in the world.
You know, Beijing officials in this report saying that TikTok strongly prefers that it remains under the ownership of ByteDance. We'll be right back. And that's opening bell on Wall Street as we kick off a brand new trading day, less than 1 week out from the inauguration of President-elect Trump. We had some of the tariff reports out this morning of gradual tariffs that's really driving the market action this morning. And that coupled with the PPI print, the latest reading on inflation coming in below expectations, alleviating some of the fears surrounding pricing pressures. That is driving this morning's action. Let's take a look at the major averages and where we are opening here today. You are seeing some relief across the board for the three major averages. You've got the Dow up just about 0.4%. You've got the S&P up about 0.5% here, getting closer and closer back to that 5,900 level. And you've also got the Nasdaq pushing to the upside here, up just about 0.7%. When you take a look at the small cap index, the Russell 2000, that's also posting some gains today, up about 0.2%. But I want to draw your attention to the activity that we're seeing actually in the bond market. We are seeing a little bit of a reprieve here for yields. You got yields moving to the downside, bond prices moving to the upside. Not too much, though. We're just below that 4.8 level. But again, we're still hovering around those critical levels to watch. Clearly still a challenge here and still concern for equity investors when you take a look at how far and how fast yields have come. Let's take a look at the sector action here at the open on an intraday basis. You are looking at consumer discretionary, industrials, technology among the leaders here in today's action. On the flip side, the laggards, you've got energy giving up some of its recent gains. Healthcare also under a bit of pressure here. The healthcare sector is one to watch in today's trading action. We're getting big updates from some of those larger pharma companies out from JPMorgan's healthcare conference. That is underway right now. That is driving some of the action here on the street. And let's take a look inside the Nasdaq, with technology being one of the outperformers here in the early minutes of trading. Got Nvidia up just about 1.5%. So a bit of a rebound here. Obviously, the stock has been under pressure for the last couple of trading days. And you've also got Tesla pointing to gains here at the open, with the stock up just about 2.5%. Let's kick it over to Yahoo Finance's Jared Blickery for a closer look at what's moving. Jared.
Thank you, Shana. We're going to head to the bond market in a second. Let's focus on stocks right now, where we have small caps leading. We have the Russell 2000 up about 1% there, and that compares to Nasdaq gains of about 0.5%, S&P gains of about 1/3%, and match that for the Dow. Let's get to the 10-year T-note yield, because now with this slight down movement, this is just a tiny, tiny little blip on the radar. That is the first day in 9 that we are seeing a move to the downside. So I'll put a 3-month chart in, and we can see since early December, we have just trended up, and this is a definite uptrend here. And this is putting pressure. This has been putting pressure on equities. And so this is one of the things that we're focused on, along with the US dollar. I don't have a catchy headline for the dollar today. It's just kind of treading water near its recent highs. But this trend even more steep and longer lasting, with fewer hiccups in it than we did see with the 10-year. So let's take a look at the sector action, and we can see it looks like tech and consumer discretionary are leading. So XLY is the consumer discretionary sector. That is up 91 basis points. To the downside, we're seeing health, communication services, and energy take a backseat today. Energy is one of the big winners yesterday. Let's take a look at, we'll get to crude oil in a second. I want to take a look at China and then disruption. And so here's China. We're seeing China lead higher today. Pinduoduo up 3.5%. JD.com closing on 5%. Li Auto above 5%. So this space has seen a lot of volatility since the pandemic, since before the pandemic, and it's just been a difficult slog this year as China has struggled over the last year to introduce new stimulus measures. Market doesn't always react well, but today it is. ARK Innovation Fund ETF holdings. Tesla, the kahuna here, up 3%. Coinbase, guess what? Crypto's doing well. We'll take a look at that in a second. That's up 3.5%. Robinhood up 6%. So the broker, that retail broker doing well. I'm going to head over to futures land, and then if we got time, I'm going to head to Bitcoin. In futures, I just want to highlight that crude oil coming off. I think we're seeing a little bit of some down action today, but we're coming off the biggest 2-day jump in quite a while. I believe it was over a year. So here we have crude oil futures. This is the intraday. Let me just put a 1 year, and you can see this movement, what I'm circling right there, that is what we've seen over the last 2 days. We exceeded the 77 level. That seems to be a threshold that was important to the market. So we'll see if we are able to head up to this 84 level that seems to have been in play before. I promised Bitcoin, that's what we will end on here. And guess what? We are up another 6.72% over the last 24 hours. I'm going to do a hit on the similarity in the patterns between S&P 500 and Bitcoin itself. These two patterns, the head and shoulder pattern, is being negated right now. So I'm just going to draw this real quick for people. Here are the candlesticks. Here we got one shoulder on the left, we got the head in the middle, we got a shoulder on the right. We had a false breakdown. It looks like a false breakdown yesterday, and then we are off to the races. 96,780. We were at 89,000 yesterday. So another successful 24-hour period for crypto. Brad.
Jared, thanks so much. Appreciate the breakdown here and the early context in today's session. 5 minutes in. It's time now for today's strategy session. Earnings season set to kick into high gear. We've got big bank results. They're coming on Wednesday, and we want to get you an earnings playbook with the companies and the CEOs to watch this quarter. Joining us now, we've got Eric Clark. He is a portfolio manager over at Rational Dynamic Brands Fund. Great to have you here with us, Eric, just after the opening bell. Let's start with financials since we have many of them reporting this week. What are your top picks to watch in the sector?
Well, I think the banks will be fine. Goldman should probably paint a pretty good picture, but we're more focused on the asset managers. There's a big trend in wealth management with money migrating from public equities and public fixed income over to privates. And so, those asset managers have had pretty decent pullbacks here, making, some pretty attractive entry points as we head into earnings. I think Blackstone is the first to report on the 30th or the 31st. So we're pretty positive on that sector.
Eric, do you think overall that earnings are going to live up to these expectations, especially when you take a look at tech? Obviously, you have earnings growth expected to cool just a bit, but still much of the market relying on some of that trajectory that we are expected to see and that optimism that's already baked in.
I think we're going to be in the have and the have not category. If you're doing well, then your earnings are going to be good. And if you're not, like Signet today is a good example in the consumer discretionary area, you're probably not. So, this isn't like last year where more and more companies were doing okay. I think it's going to be a bifurcated market with earnings because expectations are a little high going into the year.
Eric, I wonder, from the CEO voices that you're listening into most closely, to give a sense of the macro environment as well as how businesses more broadly could be or should be faring up against what is perhaps a measuring post for their industries. Who are those CEO voices that you believe are perhaps the most noteworthy to listen into this earnings season?
Sure. I mean, obviously the bank CEOs have a good read on the consumer with deposit balances and activity, but 70% of the economy is consumer spending. And so when you listen to Amazon's CEO and Walmart's CEO and Costco, I mean, that's about 17 or 18% of retail sales. So that's going to give you a good indication of the consumer and where they're spending, whether there's more discretionary spending that's going to happen this year relative to last year versus the needs side of the equation. Obviously, and then on the asset management side, listening to the CEOs of Blackstone, KKR, and Apollo, they're going to give you a really good read on overall corporate activity. These guys, can see around corners a little bit better because they own 200, 300 different companies, so they can get a good read on wages, on inflation, on growth trajectories, on profit margins. All of that stuff you can kind of make some inferences about where earnings are going to be and what sectors are going to do well and which ones might be a little bit more challenged. So the CEO is, the consumer is still doing most of the heavy lifting. Manufacturing still a little bit sluggish. So we're obviously, listening to the CEOs. And I want to hear more about implementations about AI and using technology to enhance profit margins and free cash flow. And we think, over the last 3 years, if you look back 3 years from now, stocks might not look as expensive as they do today if we get a lot of those operating efficiencies, from AI and technology.
All right, Eric, thanks so much for breaking that down for us. It's time now for our chart of the day. Let's send it over to Catalyst co-host Madison Mills for a closer look at the recent outflows that we've been seeing in Bitcoin ETFs, Maddie.
That's exactly right, Shauna. We have been seeing these Bitcoin outflows, but I do want to mention Bitcoin is up today along with the rest of the market after that softer than expected inflation print. But I want to take a look at the context here. With these Bitcoin ETFs seeing 4 straight days of outflows, the most recent date seen over $200 million of outflows from these ETFs. So that is a record. And you're seeing that Bitcoin is off about 10% from its highs following the rally that we saw in Bitcoin after the election result. Now, the key question for Bitcoin here, and a little bit of a holding pattern ahead of inauguration next week here. We know that the crypto industry donated over $230 million to candidates who they saw as pro-crypto. And now the big question, is that amount of investment going to pay off for the industry in the form of pro-crypto regulation and policies? That is going to be the key question for Bitcoin moving forward here. Obviously, we had been seeing a broader risk-off sentiment over the past week here. We saw selling off in big tech as yields moved to the upside, and that also put some pressure on Bitcoin here, which again is recovering today. But the next key question for crypto is going to be the political and policies to come out of Washington moving forward. And in terms of the market, a key psychological level for everyone to note, down $3.2 trillion. Investors hoping that the broader crypto market can maintain above that $3.2 trillion level moving forward, Brad.
All right, really key to track going forward, especially for the crypto landscape. Maddie, thanks so much. We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief.
Eli Lilly reporting prelim 2024 revenue numbers that missed the street's expectations on lower than expected sales of its weight loss and diabetes shot. Sales for the year are expected to come in at $45 billion, according to Lilly, while analysts had estimated $45.5 billion. You're looking at losses right now of just about 6%. The degree or the magnitude of this drop, it's actually the biggest that we've seen since about mid-November. Let's talk about this and more. For that, we want to bring in Jared Holtz. He is Mizuho's healthcare equity strategist. Jared, it's great to have you back here on Yahoo Finance. Talk to me about this report. When you take a look at the fact that Eli Lilly here missing expectations apparently on sluggish sales or slower than expected sales of its weight loss and diabetes shots, does that change maybe the bullish narrative surrounding this name?
Thanks so much for having me. First off, I'm pretty surprised at this move, honestly. The investment community for a while had been talking about a potentially sluggish fourth quarter just based on all the available prescription data that analysts get on a weekly basis. And so I thought a lot of this was priced in at, call it 770, 780. So a little bit surprised by this. And then when you kind of compound that with the fact that it looks like the guidance for next year, which is really the more important data point in my mind, is ahead of consensus, I feel like the stock is overreacting this morning.
When you think about what Eli Lilly is trying to, and the broader industry is trying to make sure that they can best position themselves for in a roll-off of some of the existing patents that are happening, and then additionally trying to get new approvals, whether that be in the form of a pill for GLP-1s or some other form of treating oncology. Where does Eli Lilly have the best way forward in its own pipeline here and their next blockbuster drug, from your opinion?
Well, I guess the thing is they don't really have an obvious patent situation like a lot of the other companies in pharma. This is the reason why you've got so much of the peer group trading at a PE multiple half of the S&P. Eli Lilly is the exact opposite. They don't really have any voids that I think investors are worried about. I think the issue with them is, are sales going to be profound enough to justify the premium multiple that they've gotten for the last couple of years, and is that going to continue? And I think when we look at the upcoming data sets or catalysts for the stock, obviously the GLP-1 class is the most important category by far, and they're going to have oral data for a pill, I think sometime in the first half of this year, towards the spring, summer timeframe. So that could serve as a big catalyst for the stock. And then again, I think it's really important to acknowledge the competitive dynamics in this weight loss segment continue to evolve by the day. So it's very difficult to kind of ascertain who the winners and losers are going to be on any particular day. But I still think that when we look here in a year, 2 years, even 5 years, Lilly is probably still the preeminent player.
What do you think the industry looks like under President-elect Trump? There's lots of uncertainty. We were talking to the CEO of Teva Pharmaceuticals yesterday, and he was almost hesitant to really comment on it, just given the fact that there's so many different scenarios at play. Is that cautious optimism maybe that we are seeing seeping through a little bit? Is that justified, or should there be a little bit more trepidation from investors?
I would agree with him as far as his perspective. I feel like we don't really know much. This is going to be another administration of probably a lot of rogue policy, very difficult to predict. You've got, a broader healthcare agency where a lot of the, incoming nominees are incredibly tough to call. They don't really have any experience, running these sort of organizations as it impacts public health. So I think the answer to that is we just don't know. And maybe that's optimistic and maybe it's pessimistic, but the players involved, I think, are very, very difficult to predict. I think cautious optimism is kind of like always where we come into either a new year or a new political administration, and this one is probably no different. But when you go back to Trump's last term, drug pricing was such a high priority, and the Democrats have accomplished a lot there with the IRA. So I think if you want to be positive on this, maybe this current administration, the Biden administration, rather, has made enough inroads so where the incoming Trump players are not as adamant about it.
Just lastly, while we have you, Jared, it seems like there's just going to continue to be a fire hose of news from the JPMorgan Healthcare Conference. I wonder, in the tenor that you're kind of rounding up in aggregate from CEOs, from companies, and what you're hearing and seeing be announced, what that sets up for the rest of this year and the key themes that could play out.
Well, I still think it's going to be more of the same. This is an industry where you've got 7 or 8 different subsectors that comprise it. And when you kind of look at that in aggregate, it's tough to make a call on the broader space. I think what we're seeing so far is, obviously after 2 years of dramatic underperformance, a little bit of mean reversion, I think investors are slowly coming back to healthcare. There are so many challenges, as we've discussed here today and in the past. But I think the fact that we're coming into the year at such depressed levels means that maybe companies don't have to give you all that much good news in order for the stocks to start working a little bit better. So I think thematically, that's what we're kind of seeing. And obviously, M&A is such a big piece of healthcare, especially when we talk about biotech, and that probably continues through the year as well.
Jared, thanks so much for taking the time here with us. Really appreciate it.
You bet. Thank you.
Absolutely. Everyone, coming up, we're sitting down with the CEO of D-Wave here in studio. Stay tuned.
I'm not really an expert on quantum computing. My understanding is that's still quite a ways off from being a very useful paradigm. I think Google just had some breakthrough, but I think most people still think that's like a decade plus out.
Quantum computing stocks recovering slightly after taking their second plunge in recent days after Meta CEO Mark Zuckerberg told Joe Rogan he thinks there's still over a decade before quantum computing reaches its full potential. Joining us now, we've got Alan Baratz, who is the CEO of quantum company D-Wave. Alan, great to have you here with us in studio. You've maintained that these Mag 7 CEOs are wrong about quantum. What are they missing here?
Well, the main thing they're missing is that there are many different approaches to building quantum computers. At D-Wave, we took an approach that has allowed us to become commercial today. So 2 things to keep in mind. We have customers that are using our quantum computers today in support of their business operations, and we have demonstrated the ability to solve important problems in the area of material simulation on our quantum computers today in minutes that it would take well over millions of years to solve on classical computers, including massively parallel GPU systems like what Nvidia builds.
Alan, there's been comparisons from some money managers out there that the excitement that we've seen in quantum stocks here over the last several months is reminiscent of what happened with the dot-com bubble. What's your response to that?
Well, first of all, I think quantum is real today, and it's just going to become more and more valuable over time. As I said, we are just now seeing customers use our systems to benefit their business operations, and that's just scratching the surface. I mean, we've got companies like Pattison Food Group or NTT Docomo that have us in production today. We've got other customers like Interpublic Group or MasterCard or Ford Otosan that are close to moving applications in production, and it's just going to get bigger.
When you think about the expenses that are necessary to continue to ramp the business and scale the business up at the same time that you're looking for even more revenue to match up and outpace that expense, I mean, how far away are companies like D-Wave from sustainable profitability at this juncture and really making sure that you've got the necessary capital to get to that point?
Yeah. So first of all, D-Wave is over 15 years old. We have invested to date $350 to $450 million in building our quantum computers. That's what has allowed us to get to where we are today. We actually think that we are close to having all the capital we need to get through to profitability. So not that far off, not that much more cash.
So then what does that profitability timeline look like?
Well, if I were to answer it for you, I would have to answer it for everybody, and I'm not yet prepared to do that.
When it comes to that cash burn rate, then, I guess, how should investors then be evaluating that? We don't want to go out and say, it makes sense, obviously, to put a timeline on profitability expectations, but I guess for investors to then be realistic more broadly, what do you see that rate like?
Yeah, that's a fair question. So first of all, we did announce over the last week or so that we now have north of about 175 million of cash in the bank. That gets us quite close to having a plan that allows us to get to profitability. So we don't have that much further to go.
When you think about the other companies that have a lot of capital to throw around at trying to ramp up, even though they don't have 15 years to do it like D-Wave has done, does it make sense going it alone or partnering with a larger entity, a mega cap tech company, to see this through to fruition as well?
Yeah, look, I mean, each company will have to address that for themselves. Yeah. What I can tell you is that we are very unique in the industry. So we are the only quantum company in the world that provides the types of systems we provide. They're called annealing quantum computers. We're the only company in the world that does that. And we've basically gone it alone up until now. Mm-hmm. We're making excellent progress. We are commercial. We're building the business. And we feel quite good about the prospects.
All right, Alan Baratz, thanks so much, CEO of D-Wave. Coming up, that does it for a morning brief, but Catalyst is up next. So join me and my co-host Madison Mills. We'll be right back. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We are 30 minutes into the U.S. trading day. Let's get you the 3 catalysts that we're watching this hour.
First up, U.S. stocks powering higher as investors breathe a sigh of relief on tariff reports, but inflation data looming. We're going to break down what to watch ahead of the CPI print.
Plus, traders weighing sanctions risks in the oil market as pricing pressures ease on ceasefire talks between Israel and Hamas. We'll bring you the latest.
And Wells Fargo and Goldman Sachs estimating the Los Angeles wildfires could result in losses of as much as $30 billion for the insurance industry. We discuss the implications for residents and insurers going forward.
Let's take a look at some of the market moves that we're looking at to start this hour, sponsored by Tasty Trade. All 3 of the major averages, as you can see on your screen here in just a minute, moving to the upside. Some relief from the PPI number that we got out here this morning, the latest look on inflation. And of course, as we look ahead to the CPI print, so PPI coming in below expectations. You've got the Dow up just about 94 off the highs of the session. You have the S&P also moving to the upside, up just about 0.5%. Also, the Nasdaq moving to the upside as well. Flipping over to the bond market and taking a look at yields. Again, that relentless push higher in yields have been pressuring stocks just a bit. We are seeing yields actually moving to the upside right now. You got the 10-year right around that 4.8 level. Flipping over to Bitcoin, we had seen Bitcoin under a bit of pressure, actually falling to the lowest level that we've seen since November amid this risk asset sell-off that we had seen. But again, regaining some of those losses here this morning. You got Bitcoin up nearly 5%, trading just above 96,000.
And stocks are rising today after December's inflation print came in softer than expected in those PPI numbers. Now, this comes after early morning momentum following a Bloomberg report that President-elect Donald Trump's economic team is discussing a gradual approach to tariffs. Joining us now with more, we've got Megan Horniman. She's the Chief Investment Officer at Verdence Capital Advisors. Megan, great to speak with you. So 2 key catalysts for the market this morning, obviously the bigger of the 2 being that inflation data coming in softer than expected here. How long do you anticipate this relief rally lasting?
It could be till tomorrow when we get the CPI report. That's the bigger one that I think the investors should be concerned about. And the PPI report, it's 1 month. Again, it was good data. Some of the things that we've been watching, services, that was relatively flat. Food came down. So that was a good report. But again, CPI is the bigger report tomorrow that we're going to be focused on.
What do you think we'll see in that, Megan? And I guess how much further progress do you expect in the coming months?
We're a little concerned that we're on this kind of upward wave here in inflation. And typically, when you look back at historical times of inflation, you don't have this perfect spike up and then perfect landing down, and it stays there. You tend to see it move in waves. And what we're concerned about over the first half of the year is that this refuel of economic growth we've seen since the Fed started cutting interest rates, this can reignite inflation pressures. And that's our bigger concern for the first half of this year. So we think there's plenty of pressures to the upside.
How are you thinking about seasonality within the data? Because we've seen this film before in terms of Q1 data showing a little bit softer inflation, but a lot of strength in the labor market. How does that frame your thinking of the inflation print that we're going to be getting this week?
So I think that's why you have to look beyond some of these just headline, whether it's CPI, PCE, the producer price index, to try and get a better picture of what inflation really is. So some of the things that we look at is when you look at the prices paid within the ISM services report that jumped significantly in the last month, prices paid in the ISM manufacturing. These are things that tend to lead to the higher inflation print. So we try and take out the noise of seasonality and look at some of the underlying things that can fuel that inflation going forward.
Megan, when it comes to what has been priced into the market, what hasn't been priced into the market, is the market still a bit too optimistic when it comes to the expected progress on inflation, when it comes to maybe what we are going to get from Trump policies and tariffs?
I think it is a bit too optimistic, specifically that U.S. large cap growth and technology side of the market. We've seen it's still very interest rate sensitive, and that's been really illustrated through the weakness we've been having over the past few weeks with the move higher in interest rates. So we don't think it's pricing in these upside risks to inflation for this year. And we also don't think it's pricing in the fact that the Fed probably will not have the flexibility the market expects. We don't think they'll do anything in January, obviously. And I think that the future months is really on really up in the air. We lean more towards the fact that they may have to stay on hold this year. They don't want to go through this, stop and go monetary policy that was very unsuccessful in the 70s and 80s.
Since you mentioned large caps, I want to go to a specific call you have on the tech sector, and that's in semiconductors. How defensive do you see that sector being in a volatile backdrop?
I think it's all of the areas there within the technology. These are all, I think, overpriced. So I think that's still sensitive to any moves in the broader sector. We aren't using that as a defensive mechanism right now. There is, whether you look at outside of growth, you can look at value, but all of the large cap space is trading at a premium to its historical average.
How big of a risk is that?
I think we've seen it. This is a risk for volatility. We saw a 50% spike in volatility last year. I think we have to be prepared for another year where there'll be some of these big pullbacks. There'll be opportunities for long-term investors. I do believe that. Over the long term, we still favor equities over bonds. But right now, there's just a lot of volatility, a lot of uncertainty going into this year.
So given that backdrop, I know you mentioned you still favor equities over bonds, but what does positioning look like in that case? Does it make the 60-40 portfolio look a little bit more attractive?
So I think what you have to look at from the equity side of things is going outside of the U.S. The U.S. has been really the global leader. Valuations are very stretched, and it's not pricing in any of the downside risks. And we're seeing that with these elevated multiples, really across all market caps and styles. But when you look outside of the U.S., think about the developed international markets. I'm not saying that their economic fundamentals are so much better, but I'm saying their valuations are pricing in the downside risks that are presented with those economies.
All right, Megan Horniman, thanks so much for hopping on with us at the top of the hour.
Thanks.
Take a look at the broader market, the S&P 500 and Bitcoin. The two have actually been in sync lately, and a key change in the technicals could have some big implications for the index and crypto's next moves. Let's take a deeper dive into this. Yahoo Finance's markets and data editor, Jared Blickery, is here to explain. Jared, what's the technical shift that we're seeing?
Thank you, Shauna. This pattern has been developing over the last week, and we've been watching it closely and tracking it bar by bar. The last 2 days have been very instructive. So what I'm watching here, this is the S&P 500, a 3-month candlestick chart here. Each candle represents 1 day, the open, the high, the low, and the close. And what we're seeing here, if you squint real hard, you can see this left shoulder, this head, a right shoulder, and that is a head and shoulders pattern. And in fact, we have a neckline that's right here above the 5850 level that you see on the left. And what happened over the last few days, we got a close below this level, then we got a gap down. That means that yesterday's open was lower than the close before. Then we rallied the whole day, and now we are right back up to the prior breakdown level. So we're right back up to what's called the neckline. So this is where the decision has to be made. Are we going to sell off from here, and is the next move going to look like that? Or is it going to move up like that? And this could be the case. As we know, we have CPI tomorrow. That's going to be a huge catalyst. This could set the stage for the next move into the inauguration and maybe a few weeks beyond. So that's what I'm looking at in the S&P 500. Now, if we go to crypto, and this is kind of rare. I haven't seen the S&P and Bitcoin set up precisely the same way in a while. This is Bitcoin. And again, if you squint a little bit, you see the left shoulder is setting up here. You see the head here. You see a right shoulder. It's not perfect, but then we come down. We have this neckline right around 90,000. It maybe extends up to 92,000. But what's important is yesterday we broke down below to 89,000 and we rallied strongly. And if you're doing the math here, we are 7,300, roughly 41 points dollars worth above that low that we saw yesterday. So it looks like this is becoming a false breakdown. And I wouldn't be surprised if the S&P 500 and Bitcoin are doing the same thing. And Bitcoin, by the way, is looking a little bit more bullish. Now, I had the opportunity to sit down with Jay Woods of Freedom Capital Management in the latest episode of Stocks in Translation about and asked him about the Trump trade. Here's what he had to say.
For me, the most interesting sector with the Trump trade, financials, regional banks, mergers and acquisitions, and then the leaders, the JPMorgans, the Goldmans, the Berkshire Hathaways of the world. They'll continue to do well and excel in this kind of environment. The X factor to me, that 10-year yield.
And we are watching the 10-year yield very closely because today you're going to see it's down just 1 basis point. That's a very minuscule amount. It now is back up to 4.8%. This was significantly lower only in early December. You can see just above the 4% level, which is right down here. We traveled all the way up here. And for the last 8 days, prior to this one, we are up. And this has been putting a lot of pressure along with the rising US dollar on risk assets for lots of reasons that we don't need to get into now. But we do break it down with Jay Woods. That episode is out today, and I'd encourage everybody to listen to it. I'm going to leave us on the US dollar index, which looks even more strong, which looks even more bullish than the 10-year. And this is going to be key, I think, with tomorrow's CPI release. Again, we're going to be watching stocks. We're going to be watching the S&P 500, Bitcoin in the crypto market, and then the 10-year and the US dollar. It's as simple as that, guys.
Simple as that, Jared. You make it easy. Thank you so much for breaking that down for us. Also, to our listeners, remember to listen and subscribe to Stocks in Translation. You can find that on Apple Podcasts, Spotify, or wherever you find your favorite podcasts. Coming up here, we are going to take a look at Yahoo Finance's trending tickers page. We'll give you the news behind those stock moves next. Keep it here on Catalysts.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of this session. It all coming down at Yahoo Finance's trending tickers page. First up, let's take a look at Southwest. Southwest Airlines reportedly pausing corporate hiring and promotions, also suspending most of its summer internships in an effort to cut costs. The company also cutting back on some team building events as it looks to improve margins. We had the chance to speak with Southwest CEO Bob Jordan on set just last month following the company's fourth quarter guidance raise. Let's take a listen to what he told us.
So revenue management techniques, adapting our network. It's the actions that we're taking that really boosted the guidance.
So the latest update that we're getting out from Southwest here this morning, of course, it follows its fight with activist investor Elliott Investment Management. They have been under pressure to get a better handle on some of their costs, and they have certainly undertaken many cost-cutting efforts here to better balance that part or certain parts of their business. But I think going forward, there's lots of questions just about what that long-term strategy looks like, what the low-cost business model looks like, how it stacks up against some of its competition, and then even beyond that, beyond the low-cost carriers, what it's going to do to further its market footprint against some of those larger airlines. When you take a look at the competition with Delta, when you take a look at competition with American Airlines, and what is necessary for Southwest in order to take another step in that direction.
Especially off of that point, Shauna, the fact that Delta just hit a record high on that fourth quarter beat here, really continuing to have some huge lift to the upside by doubling down on that idea of the higher income consumer, something we've heard a lot of the airlines kind of jump on the bandwagon with. We've heard JetBlue talk about it, Southwest. I thought it was really interesting from today's announcement, not only them talking about kind of delaying some of those team expansions and hirings, but also they talked about team building events that have gone back to the 80s for the company getting cut. That's always tough for the corporate morale when those things get cut out.
Yeah, and it's also interesting, and we would love the chance to ask Bob about this in the future, is just the move to cut internships. Because you would think when you're building for the future of the company, internships, getting top interns is critical for that long-term success. So that to me was an interesting move as well, but certainly we would love to hear more color on that strategy.
Yeah, absolutely. Really good point, Shauna. All right, we're also going to look at another stock this morning, DJT, on a pretty volatile ride with less than a week until President Trump's inauguration. The stock notching its best day since October early this week, climbing more than 21%. Now you can see the stock under pressure this morning, down a little over 3.5%. The big question here, what is this stock telling us, not just today, but in general? What is the fundamental story? It's not clear that there is a fundamental narrative driving this stock. Starting off the week here, moving to the upside by over 20%. There was no fundamental change to the company, to profit margins, to corporate earnings. It's really that trade that tracks the Trump administration. And so I'm very curious to see what happens. Of course, we'll be monitoring this in our special coverage on Inauguration Day, kind of what happens to this stock heading into next week.
Yeah, certainly. So we're seeing a bit of a give back this morning, off just about 4%. Of course, that follows the massive gains that we saw yesterday. But Manny, it's hard to really go any further than some of these headlines and the momentum that surrounds this stock on a fundamental basis. It doesn't trade along with fundamentals, so it's hard to draw any sort of parallels or comparisons there. But again, the lead up here to inauguration, which is less than a week away, happening on Monday. Clearly, the stock will likely remain volatile and one to watch. Not necessarily maybe a huge surprise, given the fact that once again it has returned among the top trenders here at Yahoo Finance on our tickers page. All right, finally, let's take a look at United Rentals moving to the upside after announcing an acquisition of H&E in a deal that's valued nearly $5 billion, $4.8 billion. Now, the deal is expected to close in the first quarter of this year. Taking a look, actually, United Rentals moving to the upside, up just about 4%. You're looking at H&E Equipment Services. That stock taking off, not necessarily a huge surprise once you drill down into the value here of this deal. You got shares moving up 105%. But again, what kind of advantage this could potentially give United Rentals down the line? The offer is more than double H&E's closing price of yesterday, which was $43.94. You're seeing it here this morning, right just above $90 a share. So again, a massive move to the upside here for H&E.
Yeah, a fascinating degree of that move here. And I think it's interesting given that we've seen a lot of movement to the upside for both of these names, just given the degree of infrastructure spending we've seen from the government over the past 4 years here under Biden's Infrastructure Act. And as a reminder, these are some of those equipment rental companies that you see utilized in a lot of that construction. If you've seen a huge uptick in that in your neighborhood, it's likely that you're seeing some of that equipment get rented out, and these are some of the companies behind that equipment here. So it's interesting to see kind of not only this particular deal getting done here, that $4.8 billion deal, which does include some debt here, but also just the uptick we've seen in deal making more broadly as we do head toward that key inauguration day next week, and whether or not we're going to continue to see that broadening out to other industries as well. All right, before we head to break, we're going to take a look at some of the most most active stocks by volume in today's trading day. Really interesting here. You can do this on our Yahoo Finance screeners page if you want to take a look at these stocks yourself. But we've got a lot of names on this list: Nvidia, Tesla, SoundHound, and Palantir. No surprise, a lot of those large cap tech names in here, but also a name like Palantir that drops in and out of the top performers, at least for 2024 year to date on the S&P 500 here in this list in terms of just the amount of volume and market action that we are seeing. Again, these are the most active stocks. You can take a look at that on a Yahoo Finance screeners page. We're going to have much more ahead on Yahoo Finance, so stick around. You're watching Catalysts.
House Speaker Mike Johnson saying that, quote, conditions should be placed on disaster aid for California wildfires. This coming as dangerous winds continue in Southern California, making it difficult for firefighters to gain containment on 4 active blazes in the region. The wildfires are already expected to be among the costliest in U.S. history. Goldman Sachs now estimating insured losses could be up to $30 billion. Joining us now, we want to bring in Nebraska Congressman Mike Flood. And Congressman, it's great to have you here on Yahoo Finance. Thank you so much for taking the time to join us here this morning. I want to start with the Speaker's comments that we got yesterday, just in terms of the conditions that could potentially be placed on fire aid. Is this a strategy? Why does this strategy make sense?
Well, first and foremost, our hearts and prayers and thoughts go out to the good people of California. This is still an active emergency. These are still active fires. But once the fires are literally controlled and we can start that recovery phase, the people of California can start that recovery phase, I think we have to look at forestry management and we have to look at what choices their state has made with their insurance department and how they've dealt with it. And there's a lot to unpack there. As the subcommittee chairman of Housing and Insurance in the Congress, there's a lot of questions homeowners are going to have. And I think when the fire and the dust settles, we're going to have to really unpack what happened here.
But I think for residents, they want assurance that they are going to have protections from the government regardless of the decisions of individual policymakers in the state of California. What can you say to those residents now to assure them of those protections from the federal level?
The first thing they need to call is their state senator and their state representative, because California, remember, all insurance, especially property and casualty, is handled at the state level. The federal government does not have oversight over insurance companies in individual states. It's one of the powers that states retain. And California has a requirement that carriers must seek approval before adjusting pricing, which in many cases takes months if approved at all. And that has distorted the insurance market and made it very difficult for carriers to offer consumers risk-based products to protect their homes. And these decisions, which I would say are misguided, have pushed out private insurance. And California has created this FAIR plan, which is the state's insolvent fire insurance pool of last resort. Now, FAIR's exposure has tripled to $458 billion as of last September. It only has $700 million cash on hand to pay claims. So if we're in California, you need to call your state senator and your state representative and say, what is our state?
Okay, so what are you going to do then, Representative? What's your action plan moving forward?
Well, first of all, we have to understand what the insurance environment is out there. I don't want to say today we're going to condition federal aid on this or that, because we simply don't know, A, how big the problem is, and we also don't know what the liability is. But there will be, I'm sure, a California supplemental aid package. But I'm telling the people of California, if you want that money, help us understand why we have a disaster in this state. Help us understand why major companies have gotten out of California. And why do you have so many uninsured homeowners in this state? If this happened in North Carolina, they don't have the same issues over there. Why is California in this spot?
Do we need to have more coordination, I guess, on a national basis? And how do we coordinate that strategy? What does that national strategy look like?
Well, here's the deal. For forever and a decade, it's been managed by the people of the state.
Yeah.
And it has worked quite well. This is something states do in an expert way. I live in the state of Nebraska. We have 110 insurance companies domiciled here because we have a very responsible insurance commissioner and a department that has the respect of the rest of the nation. We make sure that insurance companies are pricing for the risk, not letting the government put its thumb down on an insurance company and say, yeah, we know there's fire risk, but you aren't going to be able to charge that premium. People, homeowners get sent with, buy junk or don't buy it at all. So I am not for moving to federal oversight of insurance companies. I am for the people of California getting their house in order and making sure that people who buy policies have policies that are priced for the risk. And I have no doubt that we'll be at some point sending money to the state of California. They have to answer some questions about how this got so out of control and why so many people don't have home insurance. That is unconscionable.
So you want to leave it to the states. Is there a way for Congress to influence or encourage private insurers to stay in those high-risk areas? And I guess how do they then best go about it, or what does some of that strategy look like?
Well, first and foremost, the state has to let insurance companies price for the risk. Mm-hmm. You can't artificially say you're not going to go above this ceiling. It turns out that the market figures it out and competition takes care of itself. But in California, we have a very thumb on the problem approach from the government, and that's created a catastrophe. We have high insurance rates in Nebraska right now because we've had a lot of hail and a lot of tornadoes. My home insurance premium went up 60%. That's a cost that I'm paying. They don't let that happen in California because the government says, no, we will tell you what you can charge. And if you want to increase, you have to go through a months-long process to get that. I think my message is this, and I know my message is this. If the people of California, they need to know, first of all, the federal government is going to be a partner. We care about them. This is devastating. We understand it. And there will be a supplemental that will come to the people of California. I don't want to take over. I don't want the federal government to take over their insurance commissioner or their Department of Insurance. But I do think it's reasonable, before we do all of this, to have the insurance commissioner sit down with members of Congress and explain why California is in such bad shape. And could there be conditions? Possibly. I will tell you this, I want the people of California to get the help that they need. Nebraskans care about them. Everybody in this country cares about them. This is an all-out disaster. We will make sure they have the resources they need, but it does beg a conversation about why we have this happening out there.
But the reason behind California banning insurance cancellations, for example, is because of the impact that it has on the ability for people to continue to be residents. The cost is so high if insurance companies are able to raise those insurance costs at their own free will. Does a state like California, under the kind of regulatory purview you're describing, become unlivable for those who are not in the highest class of wealth?
Well, let's take a look at Florida. Before 1992,
right, it's really expensive to live in Florida because of home insurance prices.
But claims have gone down over time because the people of Florida have built communities with hurricane-resistant structures that are able to withstand the risk. Same thing in Nebraska. We need people to put roofs on their homes that are impact-resistant from hail to bring down the risk. None of this gets better unless we control the risk. And so forestry management, number one, what is going on with that? Number two, what can be done in building communities that reduce the exposure to risk? And what can California authorities do to better prepare for a situation like this? Listen, insurance companies are businesses. They have to enter into a contract with a homeowner, and they have to adequately assess the risk. Then they have to charge a premium that guarantees that the policy will be made good. What we have in some situations is homeowners buying a policy and they're only looking at the premium. The worst thing in the world happens, like this, and they're left holding the bag and they've got nothing to show for it. Listen, this is America. You've got to price for the risk. The government can't tell an insurance company how to price. Let competition take care of itself. Now we've got a huge problem. We have a lot of homeowners that are holding the bag. And first and foremost, I feel terrible for them. Their state government has let them down. And I can tell you, we're going to help them, but we're going to have to get a real understanding of why California's been put in this position by their leaders.
All right, Congressman, we got to leave it there. Thanks so much for making time for us today. Appreciate it.
You bet. Thank you.
We're going to have all your markets action ahead right here on Yahoo Finance, so stick around for more. You're watching Catalysts. A Qatari official says Israel and Hamas are close to a ceasefire agreement, saying, quote, "Today we are at the closest point to reaching an agreement compared to previous attempts in past months." In a statement, a Hamas official said the talks are in their final stages. Both President-elect Trump and President Biden say a deal could be reached within days. For more on the latest, we want to bring in Hagar Shamali, former U.S. Treasury spokesperson for terrorism and financial intelligence, and former director for Syria and Lebanon at the NSC, also host of Oh My World on YouTube. Thank you so much for being here with us, Hagar. I'm curious from your perspective here, if we do see countries continuing to kind of seek alternatives to fuels as we do to fuel alternatives as we see more sanctions, more broadly speaking, specifically about what we've seen recently coming out of Russia here, what could that mean for oil prices moving forward?
Well, the oil markets are certainly going to react, and they're going to react to any of these movements that you're seeing, as you've always had with sanctions. I worked in sanctions for a very long time at the Treasury Department, and every time that we ramped up sanctions, whether it be against Iran or Russia or other areas where you have sanctions, like Venezuela, for example, where you have oil, you always saw the market react, but then it would calm down again. We have to remember, but the goal of these sanctions are really to target Russia specifically and its ability not only to finance its war machine, but to evade those sanctions. And that's what the recent sanctions are targeting. They're targeting these tankers that were working around existing Russia sanctions. And not only were those tankers working to evade sanctions, international sanctions, not just US sanctions, but they are mainly used by China and India. And so this effort is also to squeeze China and India and force them to find alternatives, primarily from the Middle East. So inevitably, obviously, with that, any analysis from that is that you're going to have an increase in prices, at least for a short term, but I can't say in the long term how it'll even out in the end.
Hagar, how effective do you think the sanctions will be?
Well, I expect them to be effective. What's not easily seen in the public eye is how these sanctions really do undermine Putin's ability to finance his war machine. Remember that sanctions are just one prong of a broader foreign policy strategy, and their only goal is to make it harder, costlier, and riskier for Putin to pursue his war in Ukraine. And in that regard, over the last 2 years, over the course of these sanctions, you've had numerous thousands of pieces of equipment, of Russian equipment, tanks and other and planes and so on, that have not been able to be repaired, that are grounded because they're unable to buy the parts or get the parts, and that is due to sanctions. So sanctions, as a rule, they aren't a silver bullet. They don't work overnight. They work over time. So they are expected every time Russia finds a workaround, and that's what these sanctions were about. Every time Russia finds a workaround, it's kind of like a game of whack-a-mole. You've got the US and Europe on the other end whacking that mole. And so I do expect them to hit them. Will this bring an end to the war? No. This is about further increasing pressure on Putin while simultaneously helping Ukraine before Trump takes office.
Well, let's talk about that. What are you anticipating for the oil market under the next 4 years under the Trump administration?
Well, it's hard to speculate because Trump, President Trump-elect Trump is going to be is quite unpredictable as a leader in general. I will tell you that his proposed tariffs on Canada, should he go through with them, I have no doubt that would increase the price of oil, certainly in the United States, given how much oil we receive from Canada, that we buy from Canada. And so, but that said, President-elect Trump postures a lot. So I don't mean to say he's not going to go through with some of his tariffs, particularly on China. I absolutely expect him to go through with the tariffs on China. But other announcements of tariffs sometimes are really about posturing for negotiations to prepare the United States to be in a good position for negotiations on trade or whatever it might be, or the border or migrants. I mean, whatever it might be that he's trying to do. That said, if he goes through with these tariffs, I see an inevitable increase in oil prices, but I can't say how it'll go over the course of 4 years just because it's such a long time period.
Hagar, from the insiders that you've been talking to, I guess, what is the reception or expectation of a second Trump presidency? And just beyond tariffs, just how you see a second Trump presidency really reshaping or shaping the geopolitical landscape?
Sure. So you have a lot of things happening that are almost inconsistent. When people ask me, do you think the world will be safer? with Trump in office? My answer is yes and no, as it would be, by the way, for many presidents. And I say that, by the way, with no partisan agenda whatsoever. For example, I have a lot of hope for the Middle East, a hope that I haven't had in a long time. And that's maybe in part how President-elect Trump is expected to approach Iran. Specifically, Iran is at the root of most of the Middle East's problems. Iran is behind the Hezbollah, Hamas, the Houthis, Assad, who's now fallen. All the recent dynamics you've seen in the Middle East very recently is really in large part because of Israel's efforts against Hamas and Hezbollah and Iran. All of them are on the defense. All of them are weak, decapitated, or decimated in some shape or form, Hamas in particular. And then that led to Assad's fall, which not only that shifting geopolitical dynamic is not just about that, quote, axis of resistance. It means that countries like Lebanon can actually pull out of the impasse that they've been in for 2 years and move forward. It means that Israel has more opportunity to make deals with the Gulf. So I see a lot of opportunity in the Middle East in particular. And with China, I also expect President-elect Trump's behavior toward China to tame its expansionist policies in the South China Sea and efforts vis-a-vis Taiwan and Hong Kong and so on. However, when you're talking about Ukraine, and you're forcing, if he goes through with ending the war there the way he wants to, and Russia comes out with land, well, the problem with that is that you might have an end to the war, but that only gives Putin time to resupply, rearm, rebuild his military, and he'll only be incentivized to go after another country or more of Ukraine. And that really undermines the international order that's been set up since World War II. So there are going to be these pros and cons here. When I think about the tariffs, though, if he goes through with that, again, while I know that he's posturing for negotiations, I can only see inflation coming from those tariffs and a possible devaluing of the dollar. And that's personally what I'm most concerned with.
Dr. Jamali, great insight. Thanks so much for taking the time to join us here this morning. We appreciate it.
Thanks.
Keep right here on Yahoo Finance. We've got much more of your market action ahead. You're watching Catalyst. President Biden signing an executive order to open up federal lands for the build out of AI data centers and clean energy facilities to help power them. We want to bring in Brian Singer. He's the global head of Goldman Sachs, of GS Sustain at Goldman Sachs. Brian, it's great to have you here on Yahoo Finance with us. I know you've been digging into AI data center demand, the fact that that could boost sustainable investing here, but talk to us just about what exactly those needs look like and your reaction to what we're hearing from the Biden administration this morning.
Thank you very much for having us on. We see data center power demand globally growing about 160% by 2030 versus 2023 levels. And so to put that into context, that growth would be the equivalent of adding another top 10 power consuming country. So this is a significant expansion. In the United States, as an example, we haven't seen power demand growth in a number of years. And that's why we think this all-in approach that governments and corporates and hyperscalers and utilities are taking to try to ensure reliability, which we think is going to be a significant investment theme going forward.
And you were kind enough, Brian, to send us over some names that you could talk about a little bit more broadly here. You sent over XL, NextEra, and Southern. Out of those names, for investors listening who are really bullish on nuclear, which do you think they should look at and why?
Well, nuclear is going to have a very broad long-term potential uplift here. And, most recently in the United States, Southern brought on a new nuclear facility, which we hadn't seen in decades previously. If we think about the different ways of sourcing data centers and meeting power demand growth, nuclear is the longer-term strategy here because it takes a while to bring nuclear capacity online. And so we think about renewables as seeing a material uplift here in the near term, natural gas in the medium term, and nuclear we think will be more impactful in the 2030s. You're seeing the potential for a demothballing of a handful of plants, including the potential for one from NextEra. And then you're also seeing the combination of small modular reactors that could ramp up by the end of the decade or into the 2030s. And we also expect that there could be consideration in the U.S. for larger reactors over the longer term. We also see nuclear continuing to ramp globally, and so we do see this as a theme that not only would impact the supply chain for utilities, but also when we think about uranium as well.
With the incoming Trump administration, how likely is that, or I guess to what degree is that going to speed up some of this timeline?
Well, look, we think that the combination of the data centers as well, and the data center demand stimulated not just by AI, but also by more power demand coming from the non-AI side, with industrialization and reshoring, with also electrification, is what's going to take power demand in the United States to levels that we haven't seen since the 1990s. And certainly, I think we expect that there could be policy changes in the new administration, but we expect that this power demand theme and the supply chain from it will become investable and will remain in focus in the new administration as it was already starting to be in the Biden administration.
What's the biggest risk to this investment area in nuclear specifically from the incoming administration?
Well, I think one of the bigger risks for nuclear would just be the timeline that it takes and the investment that's required to bring on these very large or even the smaller modular reactors that we haven't necessarily yet seen. And as I mentioned earlier, in the United States, we haven't seen a lot of nuclear additions until very recently. And so it's going to require labor challenges, investment in how those investments are structured and the contractual obligations that are needed, while also providing a lot of opportunity. Now, from a big tech perspective, we see a lot of an all-in approach that big tech is taking towards sourcing data centers. You're seeing more of these nuclear contracts in addition to contracts for carbon capture, contracts for renewables as well. And we think big tech is going to continue to be incentivized to take this all-in approach, which we think would be positive not just for nuclear, but also for renewables and the broader infrastructure of natural gas generation, transmission, and distribution.
All right, Brian, we got to leave it there. Really appreciate you bringing us those insights. Thank you so much.
Thank you very much.
Sticking with nuclear stocks entering 2025 on a high as big tech continues to invest in new sources of energy to meet those AI-powered demands. Nano Nuclear Energy, a nuclear company working to develop portable micro-reactors, they IPO'd in May of last year. It's soared more than 300% since. Here to discuss what's next for the firm, we've got James Walker, Nano Nuclear's CEO. James, we've been speaking a lot with executives and analysts about the outlook under Trump 2.0. I'm curious, What policy are you most interested in getting clarity on in the weeks to come from the incoming administration?
So I think your previous guest talked about there's a lot of enthusiasm for nuclear at the moment, but I think the thing that the industry is waiting to see what will develop will be on the regulatory side. Will there be new frameworks that the NRC will implement to allow for more advanced technologies to undergo a different form of assessment to allow them to license products in a different way, more applicable frameworks to get products out to market a bit quicker? And obviously we're seeing, we've already seen pressure coming from government on the regulator to try and reform it, to modify the way it assesses reactors, and to get it out to market. But I think that's the principal thing that a lot of developers are actually looking at the moment.
How confident, James, that you're going to get clarity on this? And I guess as you try to navigate what exactly that's going to look like, how do you then incorporate that just from a strategy standpoint?
Well, we have to anticipate that nothing will change. And so as a company, we will act as if, it is the status quo. Obviously, if there is change, then obviously we will take advantage of that, as will everybody else. We do anticipate there will be change that will benefit us and all the other developers. But in the meantime, the most sensible and pragmatic way to go about running a company is to assume nothing will change, and that the current way that reactors get licensed and get commercialized as products is the way it's been done before and the way we'll have to do it. But obviously, there's certain motions underway. You see actions coming from even the individual states pushing for the implementation of nuclear in divergent and new ways. So the market this year should be very interesting, and certainly, even if you look at the long term of nuclear, there's going to be a lot of investment over a long period of time going into this sector, and that's obviously going to have an increasing amount of pressure on the regulator to not get backlogged, to be able to license these products and get them out to market.
A lot of that investment that you mentioned is coming from those large cap, big tech names, the hyperscalers that are really investing in ways to meet the AI demand in terms of energy that we are seeing. What are you hearing from tech executives about the longevity of that demand for nuclear?
So it's interesting, obviously it's known now that the US is going to have a huge increase in the amount of power. I mean, not just for data centers, but just for the country in general, reindustrialization, electrification. But no one's really talked about why it has to be nuclear for the tech industry. And what it comes down to is that tech needs a lot of baseload power. And the highest capacity factor, so really the most consistent form of power, is nuclear power, because the downtime these data centers can tolerate on an annual basis is very small, minutes at some points. So nuclear can provide that consistent power, and a lot of it. And the advantage is it can do it anywhere. So it has an advantage. You can put a nuclear power station wherever you want, and then you have 20, 30 years of consistent baseload power that can just power these centers. You can't say the same for any of the renewables, wind, solar, geothermal, hydro. They're very locationally dependent. You can't put these things where you want. They might need big land footprints, big storage facilities. The reason why net tech has gone all in on nuclear is because it is the solution. It is the only real solution long term. But in the meantime, they'll look for anything that they can do to power themselves. It'll be gas, it'll be clean coal, it'll be anything like that.
James, what does the growth trajectory look like for investors that are trying to get a better grasp on the industry? It's very complex. I was just going through some of the patents that you recently acquired. So many people are calling some of those moves or recent deals a game changer here for your business specifically. But I guess when we're trying to get a better sense of that growth trajectory, what does that look like?
So it's interesting. So it's going to be a long-term investment into nuclear. You're going to see a lot of growth, and it's going to be year by year increase. And I say that because the US is in a period now where it is reindustrializing for nuclear. So the Department of Energy is reinvesting a huge amount of money back into the country to build back nuclear infrastructure. And that's to enable us as a country to be able to mass manufacture fuel. And when we were able to do that, then you can mass manufacture reactors. So towards the end of this decade, when you start producing those small modular reactors and micro-reactors, and they're being commercialized, that's going to be the beginning of it, and then it's going to start ramping up from there. So towards the end of this decade, you're going to see a big increase in the amount of nuclear power within the country, and that's only going to get bigger as you can get economies of scale and you can mass manufacture these systems. So, and these data centers are going to need power for a long period of time. So it's fair to say that the ramp up is going to continue from now very quickly up until the end of this decade, and then from there to the 2040s to the 2050s. That's going to be the most consistent form of baseload power that's going to provide energy for these big data centers.
All right, James, great to have you here on Yahoo Finance. James Walker, CEO of Nano Nuclear. Thanks so much.
Thank you very much.
Coming up next, it's well dedicated to all of your personal finance needs. Brad Smith has you for the next hour. Stay tuned.
It's time for Yahoo Finance's Market Minute. Stocks are rising on a cooler than expected producer price index, wholesale inflation reading, and a report the Trump administration could take a gradual approach to tariffs. Chinese stocks also gaining on that tariff report from Bloomberg. Asian stocks additionally getting a boost from news a China securities regulator is pledging to stabilize the market. And we have to check in on Trump media and technology stock, DJT, lower today with less than a week until the president's inauguration. Yesterday, the stock notched its best day since October, climbing more than 21%. Eli Lilly sinking as the company says it's expecting lower sales than initially thought for its weight loss and diabetes drug. The CEO saying previous guidance anticipated even faster acceleration of growth for the quarter than they actually saw. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, tips, and tricks that you need to grow your money. Hey, on today's show, we'll dig into the outlook for earnings season. We've got Raymond James' Chief Investment Officer joining us on the show. Big guest there. Could earnings be a catalyst for the markets? We're going to discuss that. And despite a healthy labor market, many job seekers are having a tough time finding a new gig. We'll break down the challenging pockets of the market with ZipRecruiter's chief economist. Plus, Yahoo Finance teamed up with Marist Poll to survey more than 3,000 banked adults in the U.S. We dig into the findings with an all-star reporter. That's coming up just a little bit later on. But let's start where we began teasing today's show. Earnings season will kick into full gear on Wednesday with a slew of big banks reporting throughout the week. We'll also get a read-in on AI demand with Taiwan Semiconductor reporting Thursday. AI largely seen as a catalyst for the markets. Here to discuss the outlook for earnings season and the markets, we've got Larry Adam, who is the Chief Investment Officer at Raymond James. Larry, great to have you here on the program with us. As you are gearing up for this earnings season, what are the core themes that you're anticipating could prevail?
Well, first of all, I think this is one of the most consequential earnings seasons we're going to have. And really the main reason for that is that I think we're at the interaction of pretty elevated valuations. And when I mean that, it's the fact that we are in the 96th percentile when it comes to valuations. And then we have some uber optimism out there on the behalf of investors. So I think the number one question is whether or not companies will be able to deliver with their fourth quarter results and then their guidance as we look into this year. And to your point, some of the things I'll be looking for is that how companies are responding to their expectations of what happens with tariffs, with deregulation, with the strength of the dollar that we've seen here of late. And then really, what's the strength of the consumer? Because the consumer continues to be about 70% of this economy. How's the consumer doing? So we'll be looking for things like that.
Larry, it seemed like AI exuberance was enough of a thread for the past 2 years to really drive many of the company performances here and really kind of be that broad-based theme where every company was talking about how they're leveraging AI in one facet or another. But it seems like there's a new catalyst that investors are looking for here. What is that new catalyst from your mind and your own anticipation that could drive the S&P 500 higher to your target? I believe your year-end target is 63.75 for the S&P 500.
Well, two things to say there. First of all, that 63.75 is a pretty interesting target because if you do look at the forecasts that are out there, it's probably one of the lowest on Wall Street. So we are a little bit more cautious because of that uber optimism that I mentioned on behalf of investors. But I think one of the things that's going to be very important that you're mentioning is that we expect a broadening of earnings growth this particular quarter, but not a rotation. Because I do think that technology is going to continue to be a strong contributor to earnings growth, but I think you're going to start to see the rest of the market start to pick up their pace. And what I mean by that is that if you looked at the mega cap tech stocks for this quarter, we're looking for them to grow at about 22% their earnings growth, but the rest of the market we think will start to pick up at around 8%. The significance of that 8% is that that's the fastest pace of those earnings for the rest of the market since the second quarter of 2022. So it's been a while since we've seen that broader participation. And I think that'll help lift the overall market as we go forward.
Okay, given your year-end target and the fact that you mentioned it is one of the lower ones out there on the street right now, does that also anticipate that we could see some form of correction on the way to that target?
Yeah, I think that there is some vulnerabilities in this market. You know, one of the things that we talk about is the fact that when you look at investor confidence, it's at an all-time record high. And the way we get that is that there's a consumer survey out there and it asks people, do you think the equity market's going to go higher? And well over 50% of investors think the market's going to go higher over the next 12 months. Historically, when it's gotten over 45%, the market has been prone to pullbacks. and more volatility. So I think that that's likely because if you think about it, if everybody's optimistic, who's left really to keep buying stocks? So I think the market has to get a little bit, digest a lot of that over-optimism that's out there. So we do expect more volatility. We think selectivity is going to be critical this year. One of the drivers of that is that when you have higher valuations like we do right now, you actually need the earnings growth to take you higher. And that's why I continue to favor certain sectors like technology, healthcare, and industrials, because that's where the growth is going to be in the market going forward.
And so that's exactly what I was just about to ask you actually here as we're taking a look on the screen at some of your sector selectivity here. And even as you're thinking about healthcare, because that's something that's continued to come up. Of course, there's a healthcare conference taking place this week where we're getting, fire hose of information from how executives are looking across the landscape, how many of them need to figure out where they can make sure that they're retaining the consumer's mindset with even more of the innovation as we're looking at some of the IP roll-off that could come forward in future years too. Where do you anticipate we'll see even more movement in healthcare and how that will justify some of the valuations that exist right now and a rebound more broadly, I guess, too?
Well, I think it's important to look at healthcare during an election year, right? And last year, historically, when you look at healthcare, it tends to underperform during an election year because you tend to have that cloud of uncertainty about what's going to happen to the pricing, as you mentioned, and what can happen from their growth perspective. However, if you do look back historically, the year after the election, healthcare does tend to rebound because when you look at the visibility in earnings across the globe, you're seeing aging demographics from the United States to Europe to Japan, and that means you're going to need more healthcare demands. You also have people that want to live longer, so I think there's going to be more and more investment looking for these particular drugs that can help people extend their lives. And I think you're going to see a lot of momentum of that coming forward here, and that's one of the reasons why we like it, because when you look at valuations, it's probably one of, if not the most attractively priced sector in the market as we sit here today.
Some would say long life, some would say forever young. Larry, whatever you want to say, we're going to be tracking this healthcare sector extremely closely over the course of this year. Appreciate it.
Thank you so much for having me.
Certainly. Well, stocks mostly higher after fresh inflation data came in cooler than expected today. Tech stocks trying to rebound after dragging on the major averages in the last few trading days. Joining me now, we've got Scott Leidner, who is the Horizon Investments Chief Investment Officer. Great to have you here. You're warning investors not to get trapped into the idea that a strong economy will lead to a bad stock market. Break that down for us.
Yeah, look, first, thanks for having me on, Brad. Appreciate it. Look, the last month or so, really, when we've had rates trending higher overall, people it seems like are getting kind of in the realm or in their head that we're going back into 2022 when we got bonds, like basically rates going up or bond market selling off and stock market selling off at the same time, basically on the back of inflation fears. And I think people are misinterpreting what is driving the primary driver of these higher rates. The primary driver of these higher rates we've seen over the last month is not inflation worries. It is not inflationary types of things. It is growth, nominal growth being sort of re-rated higher. And that type of environment is not one where stocks generally do poorly. So I think people are freaking out a little bit because they're reminded of the recent history of 2022 and sort of the bloodbath in both asset classes that we saw. But this setup in 2025 is just not that 22 setup. And I don't want people to get fooled by it.
You say it's not smart to completely ignore non-U.S. equities this year. Why is that?
Again, so Larry was talking about some history lessons with you just previously, and this one is the same kind of thing, really. I mean, it's just sort of a call out that year one of Trump won. In 2017, the consensus everywhere in the universe, in the investment universe, was you got to overweight U.S. stocks because of deregulation and taxes, and tariff pressure on outside. So you definitely want to be overweight U.S. versus, say, Europe or Japan. And you certainly want to be overweight U.S. against a place like China or more emerging markets because of what Trump's going to do tariff-wise to them. And that was it was broad consensus in 2017. And then you turn the page and you see what happened in 2017. And Europe, international has outperformed the U.S. by about 6%. Emerging markets outperformed the U.S. by 15%. And all the while the dollar sort of cratered during the year 2017. And so it's really just to harken back to say, listen, let's not be fooled twice by the same sort of phenomenon. This year coming into year one of Trump 2. It's the same kind of call. Everybody says it's got to be overweight the U.S. You definitely have to avoid China and emerging markets because of what Trump's going to do. And I just don't want to be fooled by the same thing twice. And so, while the setup's not identical, and there's certainly more challenges abroad than there, this time than in Trump 1. It's not smart to say, listen, it's a fait accompli that the U.S. has outperformed everything this year because everybody's sort of on board that train right now.
When you think about, and since we're talking about the transition that is set to come forth here within the White House at 1600 Pennsylvania, one of the massive things that we're thinking about as well is the sectors that are set to perform better under the incoming Trump administrations and which sectors might underperform. How are you weighing that?
Yeah, I mean, like Larry, we definitely like technology. Listen, this is the mid '90s. Like the best comparison right now is the mid '90s. In the mid '90s, we saw that the internet and PC revolution come through that fundamentally changed the productivity outlook for the U.S. and for the world. The AI is him. It's the same thing. This is happening right now, and so technology, you have to be part of it. You can't be underweight tech coming in for the next several years at least. But outside of that sort of more obvious and kind of medium term play, we do like financials here for the first time, frankly, years. Trump obviously brings with him a deregulatory sort of mindset. Deregulation is just what the doctor ordered for financials, both large and small. So we think it's going to be more of a consolidation story in the financial space. So we prefer the smaller financials to the larger ones because we think the larger ones are just going to gobble up the smaller ones. And so you'll get sort of get that deal premium embedded in there. But that's certainly one that we like. As far as things we don't like particularly right now, consumer staples is top of the list. Look, for consumer staples to work, think your Pepsis and your Colgates and things that are just consumer staple wise, you got to have one or two things happen. You either have to have inflation or you got to have a recession, and we got neither of those right now. So we don't think you lose money in staples, but it's certainly not going to keep up in what we think is going to be a pretty reasonably good market in 2025. And then the more surprising one that people sort of scratch their head at when they think Trump, people generally think drill, baby, drill, and so they say, listen, you got to be invested in energy stocks, and because deregulation plus drill, baby, drill is going to be really good for those names. And historically, it's not really. The deregulation part's fine, but drill, baby, drill is not constructive towards the price of the underlying commodity. Actually, it helps depress the price of oil, which is good for the consumer and good for the economy, but not necessarily good for the equity value of things like Exxon and Chevron and sort of the big major integrateds. And so the energy sector is one that we're not really in love with right now either.
Scott, thanks so much for taking the time here with us today. Good to see you.
Hey, thanks.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got my morning brief co-host Shauna Smith here, sticking around to talk some of these trending tickers. First up, we got to go to Meta. Meta Platforms planning to cut 5% of its lowest performers, according to an internal memo seen by Bloomberg here. The shares right now moving lower by about 2.6%. There's always a bevy of news that's knocking around in the markets and investors' minds with Meta, but this major kind of restructuring that could come forward from Meta.
Yeah, Mark Zuckerberg isn't wasting any time. He has certainly announced a number of initiatives since the start of the year. This is just the latest, this coming from an internal memo obtained by Bloomberg, and bringing the total here, Meta expecting to reach 10% attrition by the end by the end of the performance cycle. So the reason why this is significant is it's 5% more than what we saw in 2024. So again, in terms of why they're doing this, Zuckerberg saying in this memo obtained by Bloomberg that I've decided to raise the bar in performance management and move out low performers faster. We typically manage people out who aren't meeting expectations over the course of the year, but now we're going to do more extensive performance-based cuts during this cycle. So again, they're looking to right-size their business just a bit. They're looking to cut costs in areas where they think it is relatively attainable, and they can do that quickly. So we are seeing this initiative from Mark Zuckerberg. And remember, this follows some of the commentary that we got from Joe Rogan last week when he joined, just in terms of how he sees Meta shaping up over the next several years. Also, a couple of changes that have been announced. One big change that was announced in terms of getting rid of fact checkers here ahead of President-elect Trump's inauguration. Again, that very much seen as a move here from Zuckerberg, trying to further cozy up to Trump here ahead of his second term. So again, this obviously very separate, this having to do with their employee base, cutting the 5% of their low performers, what they call it. So again, a move here just to further cut costs for Meta.
Okay, all right, next up, we got to talk this one because I know that corporate branding strategy keeps you up at night all the time, Shauna.
Always.
We got to talk about this one. It's going viral. Walmart giving its branding a refresh here. And here's a look at it. As shares right now, they're down by about 0.2%. Okay, this is essentially kind of the video that they put together and essentially looking at the change between what is called the spark and the typeface that they have here. And you're seeing some of, I guess, how that's all played out and the before and after. Shauna, what are your thoughts here?
My thoughts. I wonder how much they paid for this. It looks so similar to me to the point that I had to ask you if I was looking at the right thing because it's just bolder and it's a little bit brighter. And I think that makes sense strategy standpoint wise. I don't know how much an ad agency maybe should get paid for this, but the significance of this, one of the things that stuck out to me is this is the first refresh that we've seen in their logo in almost 20 years.
Yeah, that's wild.
And this is a refresh that we're getting. So again, I don't think the average typical American is going to maybe notice the difference. Maybe I am wrong. But again, if I was comparing the two, I literally had to ask whether or not I was looking at the right thing.
I'm going to be eloquent with my first comments on this, and then I'll go a little unhinged with the second one. First, though, this is a major cost as well that you need to consider, even more so than just paying some agency or maybe having somebody in-house work with an agency to come up with a new logo or typeface and how much time goes into that. All that considered, you then have to revamp marketing materials. You have to revamp everything from the in-store experience as well. You're talking about store fronts. You're talking about an overhaul of what the website looks like. That's perhaps a little bit easier. You swap out a couple vector logos here and there. But I guess on the more unhinged side, this is giving format, typeface, or format, font, bold. That's all they clicked here. To me, it's not enough. And at the same time, it's Walmart. I mean, when you think about the fact that they have a store within a 10-mile radius of 90% of America here, it's a major overhaul to go into all those stores or try to change the look and feel or the front of all those stores with this new logo. So that's a cost. But then I think afterwards it's, okay, what do we really want to convey through just being more bold, I guess, at this point? And what does that boldness look like in the product that they have, in the service that they have been able to kind of put into so many communities for so far?
Yeah, in a statement released to some media outlets here, their Senior Vice President and Chief Marketing Officer for Walmart US, William White, saying that this update, rooted in the legacy of our founder, Sam Walton, demonstrates our evolving capabilities and long-standing commitment to serve our customers of today and tomorrow. So I think when you square that with our commentary, maybe we're just not appreciating.
We're not hip enough?
Yeah, I guess not.
Yeah, no, this is giving, we didn't want to pay Don Draper, so we went to Ned in accounting. Shauna, thanks so much. Appreciate it.
Thank you.
I was excited for that commentary. All right, guys, the VIX Volatility Index. Some people call it the fear gauge, but strictly speaking, it's investors' expectations for volatility over the coming days, the 30 coming days, in fact. And here to break it down and address its controversial name is Yahoo Finance Markets and Data Editor Jared Blickery. I didn't even know it was controversial.
Well, you do now, and we're gonna get to the bottom of this. I love Steve Sosnick. He's chief strategist over at Interactive Brokers, and that's one thing he says. The VIX is not a fear gauge. It is a measure of 30-day volatility, but it's kind of a fear gauge. And what is this? We're looking at a number here, 19.03. If you take all the S&P 500 options, so those are index options that are expiring over the next 30 days. There are a bunch expiring this Friday because it's the monthlies. We got weeklies coming up. You take all the ones from the next 30 days and you get one number. That's 19.01. And when we chart that over time, what we find is these levels kind of appear. It goes up and then it just kind of reverses. And when we see the levels going up, that's indicative of traders expecting the range to expand of the S&P 500. And that usually means it's going to go down because the range of the S&P 500 of stock indices tends to go down, and the range expands more on the way down as on the way up. But it is possible sometimes that the range expands on the way up, and traders expect that, and then you see a higher VIX and a higher S&P 500, but that is not usually the case, and so usually it is kind of a fear index. We did have Slatestone Wealth's chief market strategist Kenny Polcari in here yesterday explaining why he believes 22 of these levels, 22 is the VIX's key breakout level right now. Let's take a listen.
22 is the recent breakout because we saw, if you look back on the chart over the last quarter in October, November, and again December, the VIX came up from the complacent area, tested 22, backed off, tested it again, backed off, tested it again, and backed off. And so after it tested 3 times, typically the 4th time that it tests it usually breaks up and breaks through. And when it does, it creates more angst in the market.
And that's what we're talking about, a little bit more angst in the market. As the VIX rises here, there is a little bit more angst represented by traders' fear in the market. But I think where people go a little bit wrong is they see a higher VIX and they're like, I got to buy more VIX because the market's going to continue to go down. The market can continue to go down even if the VIX retreats, because that first spike, a lot of times it doesn't last that long. And here's Kenny kind of explaining some of these dynamics.
The concern about the breakout is that stocks will weaken, right? The algos, more specifically even than the human beings, were programmed to respond to levels in the VIX. So as the VIX breaks out of 22, the most recent high, then you'll see some of the algos kick into sell mode, right? And so stocks will come under decline.
And so this just highlights a lot of what goes on in the market is systematic. That is, these large institutional traders, they have levels in mind. It could be the VIX, it could be the S&P 500, it could be the dollar, it could be the 10-year. And when you get all these levels that are important being crossed at very similar times, and right now we're seeing a lot of levels in flux right now. I was just talking about the S&P 500 and Bitcoin an hour ago. When all of that happens, you can see the market change character. And that's kind of what we're looking for. We're reading the tea leaves of the market. Now, I also have an average of the VIX, so you can call this VIX seasonality, all the way back to the beginning of calculations in 1990. So over 1 year, and this represents 1 year, the VIX traces out a familiar pattern. So we begin the year at a low level. On average, it's about 11, 12, 13. Then we get a little bit of a rise into February and March, then a retreat. Then you have the summer doldrums where, for the most part, we are a little bit quiet. But then in August, things pick up. And back to school time, back to work time, end of summer, you get this spike a lot of times in October or November. And guess what? That is prime time crash season. Doesn't mean all the crashes have to happen then, but you look at Black October of 87, the fall in 1929, those were huge October tops. And so that's what we're watching right now. We saw that decline into year end, that played out, and now we're right at the beginning of this year, just in time for a new president. So we might think, we might come to expect that we're going to need to watch the VIX to see as President Trump takes office, as the inauguration takes place, and those first few days of signing orders, what happens with the market? Are we going to see a little bit more uncertainty? We'll have to find out.
Jared, really great breakdown, and I understand now.
Thank you. The controversy, yes.
Yeah, exactly. Thanks so much, Jared. Coming up, I'll break down my top 3 takeaways from one of the biggest retail conferences in the country. Plus, small business optimism is hitting a 6-year high. We'll talk about why small businesses are feeling hopeful. And taking a look at some of the most traded stocks today from Yahoo Finance's screeners page, we're seeing Rigetti Computing, Nvidia, and Tesla top the list. We've got more wealth after the break. On Monday, January 13th, I had the pleasure of attending one of the top retail conferences in the world, NRF, National Retail Federation's big show right here in New York City at Javits Center. And I wanted to hit you with some of the key takeaways from this event. First and foremost, the reason I was there, sit-down interview with New Balance CEO, the Joe Preston, who has made his way on Yahoo Finance a few times, and we've been able to make our way up to Boston, where their headquarters is. And one of the things that they announced on stage was, as they are a private company, they don't have to share this, but they did with us. They shared that they hit $7.8 billion in annual sales. That's 20% growth versus the prior year here. And it's noteworthy, especially even as you're taking a look at us up there on that huge stage, it's noteworthy because this continues 4 years of double-digit percentage growth for the business and is key, especially for the topic that we were discussing in millennials and how companies are engaging with them in the online and physical retail experience. So that was one. Second, the AI agents were getting talked about everywhere. I saw companies with huge activations. Salesforce was there, IBM was there, SAP was there. So agents are making it into the retail conversation and could be a critical force in the future for some of the customer experiences that we have on a daily basis, especially when we might be trying to reach customer service and how those journeys get routed. Oh, speaking of some of the robots that were talked about at the conference, third here, robots are the new customer experience as well. Think about going into a store and having an associate, a new type of associate, just roll on up to you. That's exactly what you could be interfacing with in the future in that customer journey, especially when you're looking to do either some purchasing of, say, sneakers or apparel or even home goods in a store that might be too large for you to get to every portion or morsel of the store on foot. Some of those robots could be flying around and helping the experience either in discovery or in that purchase that you're making in the transaction at the end of the day. And speaking of transactions, and this brings me to my finish, the banks are getting closer to point of sales here. JPMorgan, one of those efforts that I saw on the exhibition floor, they're announcing something new here and have rolled this out, and it is essentially called JPMorgan PayPad. This really touts some of the biometrics, some of the security, and trying to make even more ease into the equation for businesses who want to leverage a point of sale, a new point of sale system that connects their accounts that they might already have with their banking provider or servicer. So all of that considered, those are some of my 4 huge takeaways. Hit us up online. Let us know what yours are if you happen to be at the conference here. All things considered here, we're also tracking small business on the day. We had small business optimism climb again in December, reaching a 6-year high. The surge was driven by steadily improving economic sentiment post-election. Here to discuss, we've got Holly Wade, who's the NFIB Executive Director. Holly, great to have you back on the show with us. Let's start there. Highest optimism index reading since October of 2018. So what's leading to this?
Well, certainly after the election, small business owners were really optimistic about policy expectations going forward that were going to be easier on them in operating their business. That regulatory environment that they've been having to struggle through over the last 4 years made a difference. And so it's interesting to see this huge swing, about a 90-point swing of net percent of those saying that they expect business conditions to improve from January 2024 to December 2024. So looking at the beginning of the year to the end of the year, we saw this massive surge in those saying that they expect business conditions to improve. So there's a lot of expectations on having a better business environment going forward into 2025 from DC at least, if not from their states as well.
The uncertainty index fell in December thanks to more certainty post-election, as you were alluding to a moment ago and mentioning about economic policies. Among those policies promised by President-elect Trump, tariffs on Mexico, China, Canada. How are small businesses thinking about tariffs?
Certainly. Well, one of their biggest issues, 1 in 5 are still saying inflation is their top challenge in operating their business. We know that the cost of supplies and inventory is very frustrating for them in absorbing those costs and passing along those costs to customers. But their first impact on absorbing those higher costs is to their earnings. So tariffs are certainly a factor in that. And it just depends kind of where the policy directives take us, how broad, how steep tariffs are, and how they will impact small businesses.
Turning now to labor, minimum wages are increasing in nearly half of the states this year. How are labor costs factoring into small business owners' outlook?
So we have about 11% right now of small firms saying that labor costs are their single most important problem in operating their business. That's only 2 points below the historic average of our 50-year survey. But labor compensation, actual compensation increases and planned compensation increases have eased quite a bit over the last year, 2 years. And so those pressures are easing up, even though historically very high. So those minimum wage increases will certainly impact some small business owners in either moving up to that minimum wage increase, that new threshold, or making sure that they're competitive with salaries that are above the minimum wage, having to increase them as well. So those pressures are still very concerning for small business owners in that it is very involved in how much they're having to absorb higher costs and passing along those costs to customers.
So which industries are facing the most difficulty from what you're seeing with filling open positions?
So right now, the 2 biggest industries, which have been the industries that have had a particular difficult time over the last number of years, transportation and construction, and also manufacturing off and on. But transportation and construction are the 2 that have faced the biggest challenges in filling those open positions. And we're also seeing that, there's this resurgence because of, what they expect as far as input costs into their business related to federal government and things like that. The tax extensions that they're looking to have preserved, those tax provisions that are expiring at the end of 2025. So, the sales expectation, open positions that are still very high levels, construction, manufacturing, transportation, those are the areas that are of particular interest that we see in the survey.
Holly, thanks so much for taking the time with us. Appreciate it.
Thank you.
Certainly. Coming up, Biden issues another round of student loan forgiveness in the final days of his presidency. Find out if you qualify next. Boeing shares are falling after the company reported its fourth quarter and full year deliveries fell from the year prior. The aerospace company delivering just 348 airplanes in 2024, the fewest since the pandemic. The gap between Boeing's deliveries and its competitor Airbus widening. Airbus reported 766 deliveries in 2024. Boeing was of course impacted in 2024 by safety concerns after a door plug flew off mid-flight in January of last year, and then a nearly 8-week machinist strike that ended in November. Job seeker optimism about the medium-term labor market outlook rose substantially during the fourth quarter, according to a survey from ZipRecruiter. Here with more on what drove the uptick, we've got Julia Pollack, who is the ZipRecruiter chief economist. Julia, good to have you on the program here with us today. So first, what is driving this sentiment improvement?
Well, the 100 basis points of cuts that the Fed has made are actually filtering into the real economy now. We're seeing banks loosen lending standards and become more prepared to lend to consumers. Home equity borrowing is picking up. And the result is that affordability is improving and big ticket item sales are going up, like vehicle sales.
And so with all of this in mind, Friday's jobs report was much stronger than anticipated, sparking a flurry of headlines about the robust labor market. But during the fourth quarter, more than twice as many job seekers characterized their experience as poor rather than good. Can you explain some of that disconnect for us?
Right. So finding a job is still tricky in this market. There's unusually low hiring taking place. Hiring rates are about where they were in 2013, 2014. There's also very little job switching taking place. And so it is hard for people, unemployed people, or people who are new to the labor market, who've just graduated from school, to break in. For workers who have a job and love it, it's a pretty good market. It is not such a great place to be if you're trying to make a change. That said, we are seeing some improvement, and part of that is because in this last report, job gains that had been driven for the last year by healthcare and government actually extended into retail and professional and business services. And so that means that more job seekers are sort of transitioning from being have-nots to being haves as their industries are being lifted.
Though job seeker sentiment broadly increased during the period, 18 to 24-year-old confidence, this was interesting. It was the only age category that saw optimism tick down. So what's the deal there among some of the younger cohorts and groups in the workforce?
That's precisely that group that's having the hardest time breaking in. Employers are still quite conservative and cautious. They're seeing strong business numbers in many cases, and they are getting excited about hiring more in 2025. But many are not quite moving yet because they want to see more evidence that these gains will be sustained. And when you're in that cautious, conservative mood, you don't take bets. You need to kind of take a bet, a little bit of a risky bet on a new job seeker, on a first-time job seeker. And that's not really where employers are just yet.
Where are we seeing the most demand, at least from how employees and those who are aspiring to get back into the workforce are seeing opportunities right now?
So we're seeing the most employer demand by far in healthcare. Incredible, resilient, sustained demand at a much higher rate than we saw before the pandemic. Year-over-year job growth in healthcare is over 3.5%, 4%, and it's across the board in all kinds of healthcare roles. Elsewhere, one isn't seeing demand nearly that hot, but there are some signs of improvement in financial services and a couple of other areas.
And then just lastly, while we have you here, Julia, I wonder how this is translating through to what you're seeing in wages as well.
The wage growth has been remarkably resilient. It did tick down in this last jobs report, but the vast majority of employers in ZipRecruiter's last employer survey expected to raise wages in 2025, and 1 in 4 said they plan to raise wages by 5% or more. So employers are still feeling considerable wage pressure.
Julia, thank you so much for taking the time and help break down some of the findings.
Thanks, Brad.
Certainly. President Biden is forgiving the loans of an additional 150,000 people 1 week before President-elect Donald Trump's inauguration. This brings the total of Americans who have had their student debt canceled by President Biden to over 5 million. So who qualified for this forgiveness? Well, it includes almost 85,000 borrowers who attended schools that the Biden administration says cheated and defrauded their students, 61,000 borrowers with total and permanent disabilities, and just over 6,000 public service workers. The Biden administration has made student loan forgiveness a cornerstone of his presidency. However, courts have largely spurned some of his larger plans, including a 2023 decision that blocked plans to cancel up to $400 billion in loans and a rejection of a proposal to lower monthly loan payments. Biden's Department of Education recently withdrew plans to deliver further loan forgiveness ahead of a second term for former President Trump. Coming up, a new survey from Yahoo Finance and Marist poll shows over a third of Americans are very dissatisfied with how much they've saved. We're breaking down why. That's next. According to Experian, the average American has just shy of 4 credit cards. But if you find yourself never reaching for one of those cards in your wallet, there may be some hidden benefits to canceling it. Bobby Rebell, who is the CardRates.com CFP and personal finance expert, joins me now to offer some advice. Good to see you, Bobby. What should the consumers be considering as they're thinking about canceling a card?
Well, first of all, thank you so much for having me, Brad. And this is a great thing to be talking about because we're often told to cancel things that we are not using, that we're paying for, things like streaming subscriptions and apps and things like that. But with credit cards, it is more nuanced. So I want to caution people to be very careful before canceling a credit card. Think about why you're canceling it. Is it because you maybe are worried about overspending? Well, there might be solutions that are very simple to avoid that. Is it because you're paying fees that you don't want to be paying because you're not using those benefits, or it simply doesn't fit in your budget? Again, there are solutions that we can talk about to get around that, because there can be serious financial consequences if you go about canceling credit cards, especially on a regular basis.
What are some of the pros and cons of canceling a credit card?
Okay, so The biggest pro is if you are paying a fee for something that you are not using. Of course, we don't want anyone to be paying that fee, but what you can do is go to the credit card company and ask for them to transition you, downgrade you to a different credit card, hopefully without a fee or maybe with a smaller fee and benefits that you're actually going to be using it. You also want to avoid fraud. That's protection from others using it. It's an easy way to simplify your finances, one less thing to take care of, one less thing to track. And of course, we don't want to be tempted to overspend. So you're just taking away that one less temptation. But there are some negatives that people should be very aware of because they are very serious. For example, it can be a big hit to your credit score. So that means that, for example, let me explain why. So it hurts your credit history. So if you do cancel, you want to cancel not the oldest one. You want to keep that credit history long. You want to make sure your credit utilization ratio is optimized, meaning you have a lot more, the more credit you have available to you, the better your score is going to be. So you want to make sure that you keep that. And of course, that you keep that in its optimal state, I should say. And of course, you do want to make sure that you keep those rewards and perks that you love to use. So be aware, there may be some that you really enjoy that you would be sad to see go.
What should consumers make sure they do if they do decide to cancel, as you've just given us some of the warnings about canceling?
Yeah, so if you do decide that it is the right decision to cancel, make sure, of course, that you pay off your balance and that you, as I just mentioned, make sure to be using those perks and benefits that you have earned, that you have paid for. You also want to make sure that you time it right. And what I mean by that is don't cancel a credit card, certainly not your longest one, before you're going to make a major purchase decision while you're applying for a loan, let's say your mortgage or a car loan, because that's going to ding your credit score right at that point. And you also want to make sure that you are strategic. Don't cancel the oldest card, as I mentioned. Make sure you document everything. Don't just assume, yeah, they got it. Make sure you have that. And then go to your other card issuers, because what you can do to help your utilization rate is ask your other credit card issuers for a higher credit limit. And that way you'll have more spending power, and that'll help mitigate the damage that you may have done from canceling that credit card that you did want to cancel for all those reasons we've discussed.
Bobby, according to bank rates, a third of consumers make every effort to maximize credit card rewards, including ones who hold the balance every month. Are there any rewards that are worth paying interest for?
In my personal opinion, no. I think that you should not do that. I think that's a big no-no. But the rewards that people are most tempted to, I should say, are probably going to be things like travel perks, because we all love, for example, to get into those airport lounges. And you can justify them. Again, I'm not saying you should, but one might justify them by saying, well, I'm saving so much money on meals when I'm traveling because I've got a big family and we can all get into the lounge. We can all get free food and drinks and have a place to work and have solid Wi-Fi and all that stuff. So you can make the case for it, but I'm still going to say, in general, credit card interest rates are so high, Brad, 20% and plus, sometimes 30% on some store cards. So really think carefully. And if you're tempted, do some math. Figure out how much interest you're really paying on those cards and then make a proactive and intentional decision. It's probably going to be saying to you, not worth it.
Bobby, good to see you. Thanks so much for taking the time. Solid insights as always.
Thanks for having me.
In 2025, over a third of Americans are very or completely dissatisfied with how much money they've saved. That's according to a new survey from Yahoo Finance and Marist Poll. Joining me now to dig into the results and what they tell us about the American consumer is our very own Casey Bond. Casey, good to have you here. So break down that stat for us. What share of respondents were satisfied with what they have in savings?
Right. Well, unfortunately, the news isn't great. We wanted to get a sense of how people were feeling about their savings right now with the new year starting, and only 22% said that they were either very or completely satisfied with their savings at this point. Meanwhile, another 35% said that they're either very or completely dissatisfied. Another interesting stat that we came across with this survey is that women are far more likely to say that they're unsatisfied with their savings. That was 40% of women versus 28% of men.
So what are some of the biggest obstacles, Casey?
Well, we certainly faced a lot of financial challenges as a country this past year, but it might not come as a surprise that nearly half of our respondents cited the cost of living as their biggest barrier.
You know, as we think about this, how are people looking to the future? And perhaps it's part of a New Year's resolution. Perhaps you're trying to turn over a new leaf, do a little bit better at saving.
Well, the good news is the survey wasn't all doom and gloom. There is a lot of optimism around saving and finances going into 2025. 44% of our respondents said that they believe they'll save more in 2025 versus 2024. And that optimism is highest among Gen Z and millennials.
Yes. All right. Love to hear that. Let's go. Casey, thank you so much for taking the time here with us. Casey Bond.
Thanks for having me.
Certainly. Everyone, we've got much more on wealth after the break. You're watching Yahoo Finance.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains. We're on for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
A programming note. In this week's episode of Decoding Retirement, host Bob Powell speaks with Lori Rowley, Icon Savings Plan founder and CEO, about the aspects of other countries' retirement plans that the U.S. could incorporate.
They have more sort of national mandates. So we have state by state, we have this patchwork of state retirement plans, which also is putting a huge burden on employers that have employees in multiple states, but that's a different topic. So I think if we had a national mandate, that would put the United States more in line with some of those other countries that get higher grades. The other component is what to do with that money once you've saved it in retirement and how to live on that money. And so a lot of other countries have programs that help people figure out how to live on that savings that they have acquired through their lifetime.
You can catch Decoding Retirement Tuesdays at 12 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. Let's get a check of the markets here as we are approaching lunchtime on the East Coast here. And taking a look at the Dow Jones Industrial Average, right now we are down actually across the board for the major averages. We're lower by about 0.2%. This right now is a 6-month chart that's populated here. And well, you can just see some of the activity that transpired in December and ultimately has permeated a little bit on over into January as well. We'll just go ahead and call this coal is what we got in December. But at the end of the day, one of the huge things that we're going to continue to track is what type of prominence the tech trade has within that move downward as well here. And we'll put this on a year-to-date chart just because we've got at least enough trading sessions to start to potentially look at this. Over the course of 2025, we've been moving lower for the Nasdaq Composite here. The tech-heavy average has certainly been hit. It's down by about 1.5%, 0.4% here on the day. S&P 500, you're seeing that down by about 0.3%. Since I mentioned technology, let's take a look at some of the sector moves that we're seeing on the day, and then I'll also bring a little bit more context to some of those year-to-date moves. XLK is what I was bringing up a second ago, down 0.2% here on the day. And of course, just to give you that year-to-date move, we're down by about 2.5%. And why don't we just put this on a year-to-date move for all of these sectors here right now, which gives us a little bit more of the clear picture as to what's been moving lower as we've started off 2025 here. You've got XLP staples, that's down by about 3% here to start off the year. Of course, we're just getting into earnings season. We had Delta last week, we had Walgreens last week, and so now we're going to get into the banks starting tomorrow and through the rest of the weekend. Also, we're going to get some CPI data. That could also be market moving as well here, so we're going to continue to track that. But as of today, there you're seeing a little bit of a mixed picture, utilities leading the charge. That's it for Wealth, everyone. I'm Brad Smith. Thanks for watching.